Welcome to Unlocked, our new video series by Triley. Through this series, we aim to bring to you complex legal issues emerging out of regulation, legislation, and judicial pronouncement. Some of these changes have a profound impact not only on our businesses, but also on the way we choose to live our lives and organize our societies. The videos are available on our website and on our newly launched YouTube channel, Trilegal Unlocked.
Good afternoon, a very good afternoon, everyone, and welcome to the Day 2 at the Mint India Investment Summit 2021. Today is scheduled around the theme, Reckoning with Uncertainty. I'm Zenia Fernandez, your host, and I am so thrilled to invite all of you to join us in yet another day of immersive conversations around the intrinsic opportunities that lie in the Indian economy. Now, while the side effects of the pandemic continue to be experienced across various industries and various sectors of our present day country, it has also reaffirmed the significance of thinking, of creativity, and of innovation in all tangible areas of business. Take, for example, our first milestone of 2021 being the first presentation of the paperless budget in the history. You know, the interplay of technology, policy reforms and initiatives, and even digitization presents to us a very exciting time for India. And today, we are all set to find out a lot more about it. So once again, thank you so much for joining us. And before we begin, I'd like to also thank our esteemed partners for making the summit a profound success. Presenting partner Trilegal, co-powered by MIDC, the Maharashtra Industrial Development Corporation, and our associate sponsor CoinDCX. Thank you once again to our partners. As we commence this summit, I want to welcome you to the social media platforms that all of us are on. You know, we'd like to extend the conversation that's going to happen on this virtual platforms onto our social media. Now, while you go there and share your thoughts, your opinions, your takeaways about everything that we're talking about, don't forget to use hashtag MintIIS. So let's begin today by talking about the India opportunity. It's my pleasure to have Munish Verma, Managing Partner, SoftBank Vision Fund, as our first keynote speaker for the day, who is in conversation with Shrutajit KK, Editor-in-Chief, Mint.
Munish, thanks so much for joining us today at the India Investment Summit. Thank you for finding the time to do this.
Well, my pleasure, and thank you for having me here, SK.
Thank you. First off, let me ask you about the impact the pandemic has had on startups, startup workers, and founders around the world this year. You have a great vantage from which you see all of this action up close. Tell us more about what has been happening.
So it's had a fundamental impact. Now, some of the changes that have occurred, right? Some of those will be transitory in nature and perhaps more short-lived, but other changes, for example, distributed workforce, right? As we've found in our own organization, that working from home has been super effective, right? There's been no drop in productivity. And in fact, as we talk to some of our portfolio companies and other companies that we're looking to invest in, we find that productivity has actually, in certain cases, even been enhanced, right? So the notion of having a distributed workforce and that workforce being productive, which people always believe that it might be the case, but this pandemic has actually proven that it is the case, right? That there's no drop. And there's no constraint, that physical constraint of having to be in the office at all times was not necessarily a constraint. So it has had an impact. And in terms of businesses that were ahead of the curve in terms of adapting to new technologies, in terms of adapting to a virtual world, which everyone knew was coming, but what the pandemic has done is it's accelerated that, and what you'd expect to have happened over the next 4 or 5 years has been compressed and has actually occurred over the last 12, 14 months, right? So companies that were doing that already, were using technology, were using data science, machine learning, were able to run their operations virtually, have benefited tremendously, right? And if you take an example of certain sectors that have had great tailwinds from the pandemic, and we expect those to continue, e-commerce is a case in point, right? So e-commerce penetration, I think in the US was expected to be 25% at some point in 2024 or 25, but it's north of that already in the last quarter of 2020. So changes have happened. I think companies have responded well to them. I think founders have responded well to them. It's obviously had a very significant cost in terms of overall economic cost, social cost, and of course, medical cost. But for certain sectors, certain businesses, this has actually accelerated their transformation and their evolution.
Right. I want to talk about India. When the pandemic started last year, the consensus view was startups would be among the sectors that would be the worst hit. And indeed, many startups have really suffered. What we've seen, however, in the early months of this year has been a slightly different picture playing out. We've seen that we've had weeks when a new company has turned a unicorn almost every day, right? In this year alone, so far, we've seen about 11 companies achieving the unicorn status. Could you tell us what are the underlying trends that are shaping this here in India?
No, underlying trends are what I mentioned, right? That look, if you've been in the business of e-commerce, for example, or if you're in the business of edtech, right? So take educational technology, right? We have a portfolio company called Unacademy in India. Now, if you were doing test, and that does test prep for students. Now, previously, to do test prep, you have to go to cities and you have to enroll physically in these classes and these organizations, right? Now, when you've got distributed learning through the power of the internet, through the power of data, through the power of technology, you're actually, those disadvantages that certain companies had, or those disadvantages that certain students might have had because they were not in a big city and didn't have access to a physical location, those disadvantages have gone away. So businesses like that, EdTech is a case in point, health tech, fintech, a lot of businesses in sectors that have used technology to service and reach out to people that they probably didn't before, or people didn't have access to those goods and services, those companies have certainly benefited. And what you're seeing from a capital point of view and a funding point of view, the market realizes that the future way that we're going to live will be based on more and more technology, and companies that are using that in the business model already are benefiting from that. And of course, there's an abundance of capital in global markets, both on the public side and the private side. So as you'd expect, part of that capital is finding its way into Indian startups, which, by the way, like to your point, right, there have been a few unicorns been created this year, but more importantly, a lot of Indian businesses now, startups, are getting to a certain size and scale where they're really catching global attention.
You talked about fintech. You are, of course, one of the early investors in the fintech space in India through Paytm. Even since then, which is not a very long time ago since you invested, but even since then, that space has seen tremendous transformation, right? I mean, UPI has completely transformed the payment space. A lot of companies have built on it and very quickly grabbed very phenomenal market share as well. What is your view on it as of today? Are you scoping for more opportunities? Are you tracking the space very closely? What are you excited about in that space?
So first of all, right, fintech is a very big space. Fintech covers payments, covers lending, covers insurance, right? And fintech is a great enabler. So if you think about what fintech has actually done, and the likes of Paytm, which is doing very well, we have another portfolio company in India called Policy Bazaar that does insurance aggregation, also doing very well. What fintech really does is, and what's allowed people to do is, for a certain section of society that didn't have access to these services, right? Using technology, you've been able to give them access to these services in a low-cost manner and quite friction-free, right? So that's had a big impact. And the more of that India as a country can do, and more of that India can bring into the formal banking system or the formal financial services system using companies like Paytm and others, the more the country grows, right? Because fintech is an enabler, right? Because if you think of e-commerce, an e-commerce platform will be as good as its payments provider, right? And the ability of the payments provider to handle multiple forms of electronic payments. So we are very excited about fintech as a sector, not just in India, but even globally. And we think it's an enabler for a country's growth. It's an enabler for the people to get access to goods and services that they previously were denied. And then, of course, using machine learning, artificial intelligence, and other big data, you can take better, more intelligent credit decisions.
Right. The other raging trend of this year that you've also been involved with, that I want to hear a little bit about from you, are SPACs, or special purpose acquisition vehicles. We saw a tremendous bull run in SPACs in early 2021 and the early months of 2021. In more recent weeks, though, we've seen investors cooling to the phenomena. We've seen regulators make some noise. Regulators in the United States making some noise around SPACs, which might have contributed to the investor response. Tell us a little bit about, and this is not new, right? I mean, blank check companies have been around for a long time. Tell us what has led to this sudden spurt in this excitement around SPAC and the activity around SPAC, number one. And number two, this very recent sort of turbulence in the world of SPAC, would this have any impact on, say, some of the Indian startups that are hoping to go public via the SPAC route?
Sure. So let's get the first thing to understand is that, look, the SPAC process to access public capital markets offers some real tangible benefits when compared to an IPO, right? So there are three fundamental things that a SPAC does. One, when you merge your company with a listed vehicle, you can actually share forward projections, right? That's point one. Point two, the process is quiet. Unlike an IPO where you go launch a roadshow, then you go public and you're taking price risk because you don't know exactly where the market will price your shares. In this case, it's a merger agreement between two companies, so the price certainty is there, and you can decide whether or not you like it. And third, of course, in certain cases, it's a shorter process. So I think for certain companies, it's a very viable product, and it's a very credible alternative to an IPO. Companies that want to access public capital markets have two options. They have three options. They can do a direct listing, they can do a traditional IPO, or they can do a SPAC. So it's a credible alternative, right? And they've been around for a period of time, but what we've seen over the last 12, 18 months, that many more private companies have wanted to access public capital markets, right? And this is another vehicle through which they can access it. So the demand has been there to access public markets, and SPACs are another way as compared to an IPO or a direct listing where you can use this technology to access. So that's what's led to the interest as more companies have wanted to get public. And in terms of your second question, the regulatory landscape, right? I know the SEC came out last week with some questions around accounting treatment for warrants. I think that will get clarified as to how warrants will get impacted or how they should be accounted for. I don't think that has any meaningful impact because it's on a go-forward basis. Indian companies haven't gone public through SPACs yet. As and when they do, this accounting treatment will be clear, and I'm sure SPACs will adhere to that. So I don't expect it to have any significant impact on the capital raising plans of Indian companies that expect to use SPACs to go public.
I'm sure the companies with such plans will be glad to hear your comments in this regard.
Okay.
I want to talk a little bit more broadly about tech and the investing environment in this space. Two companies in particular strike me as, they're both in the fintech space. Let's talk about Stripe and Coinbase, right? Two companies have not been around for a lot longer than, say, about 10 years. In the case of Coinbase, less than 10 years. Both have now approached valuations close to $100 billion. One is $95 billion, the other is $85 billion. When you think about this from a long-term perspective, this is nothing short of tremendous, right? I mean, it is really phenomenal. What is really happening here? And you stand at a unique vantage where you really have access to a very close access to the trends and the happenings in these companies very closely around the world. Is tech really eating the world, or is there some amount of overheating that's happening in these valuations, both public and private companies?
So I think, look, tech is so significant, right, and so relevant. If you take the case of Stripe, right, as e-commerce has flourished, Stripe, which started out, and of course it's now offering a lot of services, but as it started out as a payments processor, right, for e-commerce businesses, right? So as that market has really risen in the amount of quantum of GMV that's going through it, Stripe has obviously benefited, and the links with e-commerce, that's allowed them to offer new products and services to e-commerce companies. So part of this fact of companies that are fundamentally based on a tech stack that are using an innovative business model to offer or to solve pain points for consumers, or to make it easier for consumers to transact or businesses to transact with each other, are certainly benefiting from these tailwinds that we're seeing across e-commerce, edtech, agri-tech, SaaS, health tech, and others, right? So that's a real, because they're also expanding the market, right? So they're also able to reach people that were not being served by the physical world of commerce. So because that market opportunity and that market set is being expanded, these companies are benefiting disproportionately. Whether it's Stripe, Coinbase, of course, is slightly different. They went public last week, or in fact earlier this week, through a direct listing on NASDAQ. That's more, obviously, as you know, related to the adoption of cryptocurrencies around the world, and it's an exchange and wallet and some other things that if you want to transact in the crypto space. In terms of valuations, SK, look, companies like this, which are increasing their market share and will compound market share and will compound invested capital over a period of time, will do well irrespective of which part in the valuation cycle we might be. You could argue that markets are overheated. You could argue that markets are priced correctly, but there's no denying the fact that some of these companies that have been started in the last 10, 12 years that have fundamentally transformed the industries they operate in, or have created entirely new industries. And the market is giving them the benefit of that value creation.
Right, but in your assessment, is there an element of overheating in tech valuations around the world today, or not so much?
I think there is a lot of monetary stimulus that the governments around the world have unleashed. I think there's a lot of fiscal stimulus that's also been there. So I think monetary conditions and liquidity conditions are very benign. They're more benign than at least I remember at any point in my life, and I think for most people this is the most benign and the most amount of liquidity they've seen. And part of that liquidity will obviously find its way into markets, both public or private. And again, I think when you have a valuation question, I think it also becomes very relevant as to what your time horizon is, right? They're overvalued at this point in time. They're overvalued if you think of a 6-month period. So I think it's very hard to say whether valuations in tech, public, private, are excessive or not. But the point is that for good companies that are solving genuine consumer needs or business needs, that have established product market fit, that operate in sectors that have significant tailwinds, there's abundant capital available, because the belief is that these businesses will compound capital over a long period of time.
Munish, tell us a little bit about your own journey at the Vision Fund. What have your top 3 learnings been, and how has the vision of the fund evolved?
So I'll answer your second question first. The Vision Fund investment thesis has stayed broadly consistent, and has stayed consistent since the time we launched. Masa's view was that the coming revolution, defined as artificial intelligence, and when I use that word, I use it more broadly. It's not narrowly defined as in singularity, but more broadly the ability to use machine learning to make better, more important decisions, and to use big data to facilitate that decision-making process. His thesis was that artificial intelligence is the most significant informational evolution, right? It's more significant and more transformative compared to the internet, the PC, and mobile. So our view always was that we would look for companies that are using data, that are using machine learning, that are using forms of AI to transform the industries they operate in. Those are the businesses and those are the companies we want to invest in because we think fundamentally that's transformative for the next 10, 15, 20 years. And as you know, we have a long-term view and a long-term horizon. And the other thing we look for in our investments is we obviously look for ambitious, bold, visionary founders whose vision aligns or whose long-term vision aligns with ours. So that's important. And also what's important to us is that these founders and these companies are trying to solve big global problems. So the target addressable markets should be large and they should have the ambition and the stamina and the strength to go address those markets and address those problems. So now investing thesis, very consistent since the time we started. Nothing has changed. In fact, if anything, in the last 12, 14 months, it's been a validation because you've seen some of the bets in terms of, or some of our investments in terms of e-commerce and other businesses doing extremely well in these last 12, 14 months. And we would have expected that to happen over a period of time, but that's just been accelerated now. And in terms of my learnings, SK, I think, I don't know, there are three, but the two things that I've learned a lot from and are very exciting and intellectually very stimulating. One is the ability to meet founders and entrepreneurs from different parts of the world and from different cultures, right? And see how they're adapting their businesses to solve real world problems, right? So that's been intellectually very stimulating, right? And the second thing, of course, is working with Masa, working with Rajiv, and working with the other leadership folks at the Vision Fund and at the SoftBank Group, you know, and learning from them in terms of they've seen cycles before, they've been around longer periods of time, have a view on technology, have a view on the vision of the future, and how to have conviction in your ideas. So I would highlight these two as pretty significant learnings for me.
Right. I want to talk a little bit more about India and Indian startups. You know, you're a late-stage investor with very substantial amounts of capital to deploy. Is the depth of the market a concern? You know, are there enough high-quality companies and founders that you can continue to invest in, or are there too few of those and too much money is chasing them? You know, are you concerned about that horizon or that, you know, that pipeline of companies that you can invest in?
Sure. So, look, the market depth is increasing every day, every week, every quarter, right? Market depth is increasing. What you've also got to recognize, so I think companies that are raising capital are also companies, and if you look at the crop of Indian startups, right, they are also trying to solve local Indian problems, right? And if you think of the size and the scale of India, I don't believe that there is a shortage of high quality companies to invest in that can absorb meaningful amounts of capital, because the issues and the business problems that they're trying to solve and what they're trying to create also is of a certain size and scale for which certain amount of capital is needed. So I'm not worried about the depth of the ecosystem in the country. Also, one thing that has happened is as the ecosystem has matured, SK, you've got founders that have sold a certain business and have now started another business. So you've got returning founders, returning entrepreneurs. That also gives more maturity and more depth to the ecosystem because they've had successful exits. So there's a greater amount of confidence. And also, I think Indian businesses, and maybe in the past, it might have been the case that you would look at a business model from the West and try and adapt it or import it into India and, you know, work on that basis. But that's changed. A lot of the entrepreneurs, a lot of the companies that we are talking to and we are investing in are coming up with solutions that are solving local Indian issues, right? And have the capacity to absorb that capital.
Yeah, I'm glad you brought that up because I had a, you know, there's a related question that I keep wondering about, which is in the first wave and, you know, in sort of the first cohort of startups that sort of grew into a very big scale, we saw a lot of business models that existed in other parts of the world, right? Increasingly now we are seeing some very original companies coming out of India, especially in the SaaS space, who are from day one, they are global companies in that sense. You know, their markets are global. They might be based in Chennai or, you know, many founders soon enough move overseas and so on. But, you know, many of their workers sit here, but their solutions and products are for the global market. And the unit economics are such that from day one, they are, if not profitable, I mean, their unit economics are positive, which means they don't need a lot of investor money, right? Sure, I mean, if they want to expand very, very quickly and, you can push the sales force and so on and so forth. But even then, because they're not trying to, burn cash and acquire customers and so on. What do you make of the rise of such startups? Does it concern you that strong business models which don't need a lot of investor money are on the rise?
I think it's phenomenal. Because Indian SaaS companies, like you said, right, maybe based in India, but they're addressing global markets. Their biggest clients are in the US and Europe and Australia and other parts of the world. The business model is such, gross margins are high from day one, right? And then the only question is the trade-off between profitability and growth, right? Obviously, you can spend more money in terms of increasing the rate of your growth, hiring more salespeople, having a more aggressive go-to-market strategy. But the underlying business unit economics are fantastic, right? So in fact, we love businesses like this that have proven unit economics, but that could take some capital so that they can accelerate their growth, right? And that's, I think, a sweet spot. And from an India point of view, I think to have the rise of these businesses in India, serving global clients, and we have a couple of investments in the SaaS space, which are Indian headquartered companies, but obviously serving global clients, I think is very encouraging for the country, right? And we are super excited to see that. And I know more of these will emerge. Some will be more vertical in nature, focus on certain aspects of an enterprise's problems. Others will try and be more horizontal platforms on which other applications can be built. So very enthused by that development. It doesn't, I mean, and I think when we invest in these, we will have some very good outcomes. And India will have some very big outcomes from the sector in the months and years to come.
Munish, you would have had the, the last few years that you've been very closely been involved in this space, you would have had had a sort of ringside view of the evolution of the Indian startup scene. Tell us, what are the three most common mistakes you see startups and founders making in markets like India?
Look, I don't know if I can count these as mistakes that founders make, but I can tell you that a couple of things founders grapple with all the time, right? One, obviously, is the trade-off between unit economics and profitability, right? At what point do you press the accelerator to have greater growth? At what point do you focus more on unit economics? And it's not something that we've seen a consistent pattern on, but certainly it is something that a lot of the founders that we talk to and a lot of our portfolio companies as well, it's a decision that these founders have to grapple with always at all times and, decide on as they grow their business, right? And the other question, of course, is suitability of business model. You could argue that maybe, going back a few years, and it's not true just to India, but a lot of business models that related to tech and related to disruptive companies were invented in the West and were being exported eastwards, and people are trying to adapt those to those local countries. And now what we see increasingly is new business models being created that are more relevant to the local country, trying to solve, in the case of India, India-first problems, using a native tech stack, and building on the tech stack, by the way, that India has through Aadhaar and UPI. India has a very good India stack that people can build on. So those are I wouldn't call them, like I said, they're not necessarily issues, but these are decisions that the founders have. And we've seen that consistent pattern of people having to grapple with these decisions on almost a daily basis.
Munish, tell us about SoftBank's investee companies and how your bets in these markets have played out and are playing out.
Well, look, across Vision Fund 1 and 2, we're investors in more than 100 companies, right? And of course, as you know, our investment portfolio is geographically spread: India, China, Southeast Asia, the US, Europe, and others. And a lot of our investments, as I said, our thesis has been consistent through this process. Our thesis was companies using tech, data, machine learning, solving real pain points, frictionless, user interface driven, convenience driven for the consumer business. In these last 12, 14 months, a lot of them have played out, in fact, exactly as we thought they would play out, if only we also have been surprised with the speed of adoption of some of these business models. So we've had quite a few companies go public in the US. We obviously saw we are shareholders in Grab that announced a merger with a SPAC earlier this week. We had another portfolio company out of South Korea, Coupang, that went public a couple of weeks ago.
Yes.
So we've had significant companies in life sciences in the U.S. go public, whether it's Guardant Health, Weird Biotics, there's Slack that went public in the U.S. So we've had our investment thesis play out broadly along the lines that we had anticipated.
And what about India?
So India, look, that's one of the things in the Indian ecosystem that I would love to see more of is more exits. And I think this is the year when you start to see more companies. And when I say exits, I mean companies graduating from being private companies to being public companies. And we have a few in our portfolio that are actively contemplating accessing public markets. I know there are others in the ecosystem that are also doing the same. So I expect 2021 and over the next 12 months, a few Indian companies to go public, and that will be another sign of the maturity of the Indian ecosystem.
Before we let you go, let me ask you one last question. How do you view the long horizon India opportunity?
Very optimistically, SK. Very optimistically, right? And the optimism stems from a couple of factors. One, and everyone talks about this, there is a demographic dividend in the country if utilized correctly, right? There is serious internet/smartphone penetration in the country, 600 million people, majority of which are under the age of 40 that are using it, right? Cost of data has come down significantly over the last few years. 4 or 5 years ago, I think data would cost a few dollars a gigabyte. It's now less than 10 cents, right? So big impact that's had. And India has had a lot of consumption on the internet where news is getting consumed and other things. Consumption is high, maybe 200, 400 million of people that actually consume information on the internet. Transaction is still less. Transaction is significantly less than that. So over the next few years, we believe that a lot of people that consume information but not yet transact on the smartphone or on the internet will move to be transacting users, right? And that has great implications for businesses, whether they're in e-commerce, whether they're health tech, whether they're ed tech, right? And again, from a country's point of view, the fact that these businesses can take goods and services and offer them to people that didn't have access to them before because they didn't live in a big city or were far away from a big city, that will have a meaningful driver, and that will be a meaningful driver to India's growth going forward. So, and one other point I would like to mention, I think the quality of the Indian entrepreneur as well, right? The capability, capacity, drive, vision is second to none. Is absolutely second to none. And our view is that over the next, and you mentioned about SaaS companies that of course are Indian incorporated and domiciled, but with global clients, we believe over the next X number of years, a few Indian companies will actually become, not just in SaaS, but in other sectors as well, will actually become global companies with business models that were invented in India.
Great. Wonderful to hear that, Manish. It's been a real pleasure chatting. I know how busy you are, and therefore, from all of us, thank you so much for finding the time to do this and for joining us at the India Investment Summit.
My pleasure, SK. Thank you for having me, and good luck with the rest of the summit.
Thanks so
Of private equity in the present scenario. Let's take a look. Okay, so we're moving on to our next session. We have a panel discussion on private equity, the opportunity in the crisis. Now, the disruption that's caused by COVID-19 and the geopolitical winds of change that followed have opened up new opportunities. With digital adoption growing at such a rapid pace and even shifting supply chains, long-term growth opportunities have definitely opened up in many, many sectors. New age technology companies are also showing signs of successful exits at attractive returns, while the government's push for scaling up domestic manufacturing is poised to make India far more competitive with other economies, including China. Now, while private equity invests in new age digital companies, is Indian manufacturing an attractive investment destination for PE capital? The panel is going to look to answer the big question: where is PE betting its money in the new decade? Ladies and gentlemen, let's welcome our esteemed panelists to our screens. Shashank Singh, partner and head of India Apex Partners; Nikhil Srivastav, partner and managing director, head of India Private Equity PAG; Utsav Bajal, senior partner, head of India Private Equity Apollo Global; Renuka Ramnath, founder, managing director, and CEO, Multiples Alternate Asset Management; and Harsh Pius, partner, Trilegal. Neha Grover, the South Asia Regional Lead, Private Equity International Finance Corporation, could not join us for this panel due to some unavoidable commitments. But joining us is also moderator of this conversation, Osam Shukla, Managing Director and Head, Corporate Finance, Investment Banking, Ambit.
Okay, are we good to go on the start? So, good afternoon, everyone, and thank you for joining us here today. I've got a rock star panel here today, representing a very the stalwarts for private equity in India, and so it's a pleasure to host this panel. So I think before we start, I think we just wanted to maybe just set context. I think the topic for discussion today is private equity and what happens over the decade ahead. We were kind of looking at what happens, how private equity evolved to start with over the last decade, and essentially how we've seen some of the trends picking out, and then would love to kind of pick the brains of this esteemed panel to hear this more. Just 1 second. Okay. So over the last decade, we it's been probably an interesting theme, and you see that deal making across the board. Split that out into first half decade, which was a lot more muted, and second half, which saw significantly higher deal volumes. We saw deal volumes on an average going up from around $10 billion to closing the decade closer to $40 billion. About 2.5 times average annual deal size. 4 times increase in average volume in the year, with about 2.5 times increase in average deal size, and accompanied by nearly a doubling of the average number of transactions a year by private equity. Interesting in terms of the mix. However, we haven't seen a very wide shift in mix. technology across different spectrums, has remained the single largest component of transactions, followed by financials, infrastructure, healthcare, and others. And I think that's generally been a trend. I think, whether increasingly we've seen in the latter half of the decade, technology kind of significantly picking up steam. And in terms of purely stages, I think that's been a big shift we've seen over the last few years in particular. Buyouts, which were few and far in between a decade ago, are already the mainstay and perhaps, one of the largest components of transactions as we're seeing now, particularly in terms of value. Significant increase in late stage. Very encouraging to see, very strong growth in the growth investments and early stage investments, and hopefully that propels to some of the investments coming ahead as this panel kind of comes into sorry, went on mute. So to start the panel, maybe I'll request Renuka to maybe share her thoughts. I think Renuka, you've seen the entire evolution of private equity in India. Both as a private equity professional and of course as your as the chair of IBCA in India. How do you see the evolution going ahead? Key trends. How relevant has private equity become to India?
Yeah, I think after several decades of hard work by all the professionals in the industry has got a center stage now. Probably this is the only industry which brings external long-term risk capital, whether for growing new businesses or for restructuring existing businesses or for real estate or infrastructure. Venture capital activity has really, I would say, grown at a phenomenal pace in the last 5 to 6 years, driven by digital acceleration. And COVID has given a fantastic tailwind for these businesses. But the beauty about the private equity product is its flexibility. It can be for growth, it can be for problem solving, it can be to sort out shareholder. Some shareholder wants to leave, some shareholders want to stay. It is for carving out non-core businesses. It can be for M&As, it can be for troubled assets. And then there are, I would say, very special uses for infrastructure and real estate. So I see that this industry is going to be playing a very, very important role in the $5 trillion dream that our Prime Minister has articulated. We expect that typically, it's a 0.2 to 0.3%, GDP to PE ratio. So in the next 5 years, I would expect that we would get anywhere between $25 to $30 billion of private equity into the country. And then from there onwards, it would grow. And also there have been a lot of facilitation by way of AIF regulation. More recently, the GIFT City, which provides a lot of tax clarity, for entry and exit of private investments. So I would think that this is, at the center stage of speaking for how India can achieve its GDP growth.
Thank you for that, Renuka. Maybe I'll ask Shashank. I think as in the context of as Renuka mentioned of how private equities are likely to slated to grow very significantly from here, and one particular theme which has been central as we saw over the last decade, and perhaps potentially more, is technology, and perhaps technology splitting across core technology services, product companies, and also some parts of of course the the fancier digital digital technology, consumer technology companies. So, from your experience, you've been at the forefront of some of the large technology buyouts in India and globally. How do you see that?
So, Ozang, absolutely. I think it's a very important trend that you have picked up on, and I think Renuka also referred to it, that private equity is ultimately flexible risk capital and goes towards all sorts of things, right? Whether it is growth of younger companies, whether it is to facilitate evolution of economies from more traditional parts to more digital, as we're seeing around the world, and the pandemic sort of increasing that push, or whether it is buyouts and restructurings and transformations of companies and parts of the economy. And if you sort of apply a technology overlay over this, actually, I think you see all parts of this play out in India and have played out over the last 15 years, and our prediction is will continue to play out significantly. If I was to kind of just broadly divide the technology investing into two buckets, I would say the first is more traditional businesses as far as technology is concerned, which I would sort of put into the bucket of IT services or IT and ITES, what we at Apex call tech-enabled services. And this has been a good chunk, but an increasing chunk of where private equity has gone, particularly buyout and late-stage private equity that you talked about as you were going through the market stats. It's been a big focus for Apex, as an example, in the country. Of the 10 deals we've done over the last 14 years in India, half of them, 5 deals have been in technology, 4 in IT services, 1 in software, all more traditional businesses, I would say, for the most part. But that's, I'd say, late stage buyout and private equity. The other aspect, of course, is the things that are more to do with the digital economy, consumer tech, software, SaaS, and so on, earlier stage capital, venture capital, tech growth, which we're sort of seeing the exciting emergence of all of this around us. Every time you pick up the financial press, you read about a new unicorn born every day practically, and there's a lot of risk capital that's going into that, and that fundamentally, I think, will change the landscape of what the economy looks like. It's very much part of the process of creative destruction. I think a whole bunch of new companies will come up with early stage capital there, but it will also mean that there are parts of the economy that will struggle as a result, because it's at its heart is fundamental disruption. And I'd say that also links with kind of the third point I wanted to make, which is if you look at technology as a proportion of private equity globally, it has been an increasing trend over the last 20 years, and our prediction is it will continue to increase very significantly. And that's a trend we should be prepared for here in India as well.
Thank you for that, Shashank. I think interesting thoughts you said about the entire creative destruction there. Just staying on a little bit on maybe technology and buyouts, and buyouts, maybe picking up from that, and buyouts in general. Maybe what's up if I'll ask you, from your own lens, you've kind of straddled a few products, a few technology, IT services buyouts, to looking at special situations. How do you view this going forward? And how important do you think we've seen buyouts become significantly larger? Do you see that kind of picking up more? So I think you're mute.
Now?
Yeah, I can hear you now. Perfect.
Okay. Sorry for that, and thanks, Osam, again. It's interesting hearing Shashank speak. I was thinking about when we opened the office in India. The market was not mature. About 5 to 6% of the market was buyouts, and today it's close to 50% of late stage deals are really controlled deals. And I think this, our view is this will only increase over time. I think from a trend perspective, I think this is nothing but a natural progression of the market, where you've seen finally sellers accepting this as something which they can do. It's become a lot more acceptable for businesses to actually sell. And secondly, the private equity firms have become much more confident about India, having been here now for 15, 20 years, to not only own businesses in IT and BPO, but across different segments. And so I think that you're going to see a lot more of this. And if I think of three events which have catalyzed this, I think the first was the sale of Ranbaxy by the brothers. I think when that happened in 2008, it was probably one of the largest companies which got sold by a family going through that generational change. And everyone sort of sat up, and at least I know friends in Delhi and business families where they say, okay, listen, why can't I even think about this? And it kind of changed the mindset a little bit and took away the stigma which was associated with selling the business. Somehow it was like you're giving up or something. But no, this was doing something positive and wanting to build new businesses. And I won't talk about the story itself, but I think that was a catalyst. The second catalyst, I think, has been the IBC. The IBC has not resulted in as much change of control as we would have all liked. But what it has done is that it has made debt something which now groups have to take seriously, promoters have to take seriously. And you have to really think about protecting your core balance sheet in your overall group by selling off businesses or segments which you can't sustain, right? And protecting your balance sheet. So while IBC may not have caused that shift, I'm seeing a lot of people finding growing businesses much harder, managing the lenders much harder. Credit actually has some teeth, and that's prompting a lot of activity. And then finally, I think COVID is going to be the third catalyst for this. I think all of us have sat through this lockdown and thought about ourselves and reflected about what we want to do with our lives. And companies and groups have also done the same thing, right? They have thought about what businesses we want to focus on, where do we want to grow. And similarly, I'm seeing a lot of young second generation members of their families who are saying, listen, I'm in a manufacturing business, I don't want to do this anymore, or I'm too small in an environment where the large are getting larger, and consolidation is the way to go. And so I think this is the third catalyst. And so I only think that this is going to become a big part of the private equity business, and it's going to change the way companies are governed in India. And I think that's only for the positive.
Thanks, Utsav. You spoke about carve-outs and how that's coming out, and maybe it's only natural to kind of pick on Nikhil. Just kind of carving out a great business, as a buyout. But Nikhil, how do you see that? I think particularly around distress debt buyouts coming in, and within that, how do you look at technology? Maybe, and I'll just kind of ask one flavor on that. Technology being a disruptor for some of the businesses you are ending up buying out. How's private equity looking at that?
Good afternoon, everyone, and thank you for having me on this panel. So Asang, as we've looked over the last few years, the macro in India has been weak due to a string of events, starting with the demonetization, followed by GST rollout, IL&FS crisis, and now COVID-related market dislocations. In some ways, the Indian companies, especially financial services companies, were probably better prepared for the COVID pandemic than they would have been otherwise. Unfortunately, none of us have a crystal ball, and it's hard to predict how long the downturn will last and what the shape of the economic recovery will be. But in such uncertain times, we as a firm have focused on a few themes. Maybe I'll just call them out, like the first one being buying high quality businesses that have leading market share. We believe that the big will become bigger as they're able to upgrade talent, have preferential access to capital, and can grow both organically and inorganically. Carve-outs is something that you mentioned, of assets from conglomerates that need liquidity, where the parent is in stress and needs to raise liquidity over a short period of time, where they have to sell some of the crown jewels at times and sometimes non-core assets, as Revika had mentioned earlier. Restructuring of a global supply chain. I think this is pretty relevant for the API theme. And then finally, as you were mentioning, we are focused on businesses that can embrace technology to enhance customer experience and reduce the cost to serve customers. So maybe as an example, as you mentioned, we recently acquired control in Edelweiss Wealth Management, which is the #2 independent wealth manager in India. We believe wealth management has increasing tailwinds due to financialization of savings, and Edelweiss Wealth Management is one of the few independent wealth managers who can leverage technology and a large portfolio to serve the needs of growing affluent population. This company, in our view, is a prime candidate for digital transformation. And that is a big theme for us as a firm. And maybe I'll dig a little bit into this theme. So today, we all would agree that the global economy is undergoing the largest tech transformation in history, as has been alluded to by Renuka, Shashank, and Utsav. We are witnessing fundamental shifts in consumption patterns across consumers and businesses, which have been accelerated in the post-COVID era. And disruptive innovation is likely to displace industry incumbents, increase efficiencies, and gain market share. So our key takeaway is that as technologies emerge and transform entire industries, investing in traditional players is actually more risky than we appreciate. And in our view, companies need to pursue digital transformation to not only capture the benefits of these trends, but to simply keep up with the competitors. And our goal as PAG is to become the catalyst for these transformations. We can help these businesses to reimagine their business models and accelerate the adoption of digital and analytics.
Thank you for that, Nikhil. I think interesting perspective. I agree. I think we hear everyone wanting to step up their own internal digital transformation stories, and you're right. I think with access to greater capital and global networks, private equity actually perhaps becomes a big catalyst for that. But all these great themes, aside, I think I've found that over the last decade, one thing that has kind of significantly also changed in private equity is how quickly we have to bring the lawyer into the room when discussing a deal. And I think which is why we're quite happy to have Harsh on the panel. And Harsh, would kind of love to hear your perspectives on particularly how have you seen the perception and reaction to regulatory risk in deal making over the last decade, and how do you see that evolving? Harsh, we can't hear you. Sorry.
I said, sorry, thanks for having me on this panel. In fact, I was on mute, which is where most people like to have lawyers. But that said, I think the shadow of legal consideration sort of looms across the industry, and in ways that are both positive and sometimes concerning. So as the industry has matured or moved further towards maturing, certain types of regulatory issues which were considered to be par for the course have now become different. I mean, the attitude towards compliance has matured to some extent. The scope for what people call fat tail risks has also increased. In other words, low likelihood eventualities, but which could have very negative consequences. So, so I think this is only one aspect of regulatory considerations, but I thought that since that's the one that strikes us first, it's probably worth dwelling on. Yes, it has become much more important to think about these issues. We have also seen a cycle as the private equity industry has grown. We have seen a cycle of litigations also, which of course no one wants to be part of, and no one enters into a transaction wanting to sort of foreseeing something like that. But ensuring one is well positioned should that event occur is of course important. Sometimes is there the right compliance mechanisms? Are there the right levers of to ensure a negotiation can produce an outcome rather than litigation? So those are the sorts of things which people spend a lot more time on. But let me touch on the other two aspects of regulatory, regulations, which are very relevant for the financial investment industry, and that is there are a set of opportunities that have been created and will continue to be created. In fact, it's likely to be accelerated as a result of regulatory change. So, for instance, the whole bankruptcy regime, it's continuing to evolve. Pre-packs are now, on their way. There's an increasing trend towards localization, which on its face seems like it could cut both ways, but for the private equity industry may actually provide a competitive advantage over multinational, since sometimes they may be competing for the same deal. Payment systems are continuing to evolve. Recently, there are some changes on maps. So there's ongoing, which will create new opportunities. For instance, there are these new umbrella enterprises is a new payment mechanism which is in the market, potentially going to be in the market. And I think sometimes we should focus on the positive opportunities that may come as a result of regulatory change. And it's particularly acute, I would say, in the tech-driven industries, but also other industries like infrastructure and so on. And of course, financial services has always been heavy from that perspective. Then there are the sectors where there is scope for adverse outcomes because of regulatory change. And that's the regulations which have changed across the board in those sectors. So it's become all the more important. And as the pace of change has grown, I mean, it's really been at a blinding pace. Even as lawyers, we struggle to keep up with, exactly what's happening in which sector. But it's become all the more important to be able to predict the trajectory of change. One cannot assume that it will be static for a business model, and therefore, regardless of industry, but probably more so in some industries, tech is a good example. A failure to anticipate the direction of change. So, for instance, our competition rules are continuing to change. All countries are beginning to relook at how they look at big tech. India is definitely amongst them. There's a new data privacy law that's going to come in. Is that going to affect the business model? So, in the past, we have seen e-commerce. We'll see how that develops. So I think that's the third aspect in which regulatory considerations are increasingly, relevant to the industry. Though, of course, it's really about making the business opportunities and bringing capital and having the right partnerships. Those will always be the more important parts of this business. But let's say that these are, as you said, sometimes initial issues as well, because they sometimes affect the economics.
Thanks for that, Harsh. Maybe if I'll just kind of then shift gears and see, in terms of, of course, we spoke a lot about parts of technology, and but maybe it's the entire evolution of technology is also kind of putting another fundamental deal evaluation. Is that changing, right? Because fundamentally, venture capital did venture stuff, private equity did cash flow based investments, fundamentally different perspectives. I'll ask, it would be great to get a few of your perspectives, and maybe I'll ask again, Renika, again, you've straddled, some early stage digital companies to, at the same time, doing, traditional regular financial services and other companies, manufacturing companies. So how do you think private equity looks at some of these new age companies?
Yeah. No, I would say in multiples, we are privileged that, we have negotiated with our LPs for this flexibility of straddling from slightly earlier stage all the way to mature business. And that's a very intentional one. I mean, Nikhil very correctly said that it's more risky to invest in a traditional business than in a younger new age business. So from a portfolio construct perspective as well, I like to give a mix or to my LPs of emerging opportunities as much as high growth in more established, kind of businesses. As all of us know, there is really no right and wrong in this business. You have to build a shop that is capable of straddling this opportunity, right? I mean, somebody could turn around and say, I just don't believe it. How can you have a team who can do such an early stage business which looks more like venture capital, where you're dreaming and you're worrying about the next round of fundraise and at what valuation it will happen, and at the same time do a buyout of a more traditional business. As I said, Osang, I think the way at least I built multiples is to be entrepreneurial, no matter in which spectrum you are investing. And how do you connect at the level of the mind and heart with the entrepreneur? And how do you bring horses for courses? So when you are talking to delivery, you would have a very different, kind of conversation around what are the possibilities, how can you enhance your moat, what risks you should take. So it'll be very different from, let's say, talking to Cholamandalam, right? Finance, which is, at the time we invested, it was more a turnaround. And abandoning some of the businesses that did not work for them and getting back to mainstream. Both are highly value creating journey, but we should be very careful not to do a one cap fit all model. And speaking to this entrepreneurial capability, we went out and built a housing finance platform in Vastu, right? We started from scratch. It's a 2,500 crore company with some of the most compelling matrices of performance in its space. Easily one of the best companies in its space. Again, it is because of our background. I built India's first bill payment company when I was in ICICI. So some of that training has really helped us to straddle these multiple opportunities that India throws to collectively give a good risk-adjusted return to our LPs. But it requires a little bit more investment internally, because I will need teams who bring different levels of expertise. So I'll have to invest in that and be very, very careful that we are not taking a wrong, tool to a wrong situation. So, but if one is able to do it, I'm able to kind of quickly latch on to where there is a gap between the valuation and the market seeing that opportunity, right? And moving in quickly there, rather than be stuck in a corner where valuations have already got re-rated and you either do it or you're just standing by the side and watching what's happening in the market. That's really what happened with housing finance. We found that we would get tiny stakes in tiny companies on a $50 billion macro opportunity. We said how big of a risk it is to get started, and we found a brilliant team. And then we said we could trickle capital. We really started with $5 million and increased our exposure to $100 million. So that's I would say, the beauty of the product and the market. If you have that capability built in your shop, and no problems of having to convince IC member in some other market who may uh, you know who may think that these are vitiating the firm strategy because we are homegrown and everything we give and take only in India. That flexibility is further possible for us.
Well, that's interesting perspective. I think and I think I think some of the other global firms have trying to do slightly different as well. Maybe coming out with specific themes, right? In a way, I know KKR has launched a KKR Growth Fund. The Apex, of course, Shashank, you have the Apex Digital Fund. I don't know any perspectives you have on this. How will private equity look at some of these value creators, disruptors over the next decade?
It's a good question, and I think Renuka has obviously a fabulous business model where you have the flexibility to do it across one platform. In our case, we have different pools of capital for different types of deals, and what we find is The way we kind of pitch ourselves to investors is to say, look, we will look for the best deals in not just the sectors, but the subsectors we really, really understand. And we look for the best deals around the world. And if they're late stage buyout deals, we'll do them out of our buyout fund. If they're tech growth deals, which actually harks back to our original origins, we looked, when Apex 30, 40 years ago looked a lot closer to what Multiples does today, where we used to do venture growth and buyout all out of the same fund. But over time that changed. But we have raised, as you said, Ozan, this vehicle called the Apex Digital Fund, which will do tech growth. So late stage venture, Series C, Series D, or tech growth, as we all understand it, again, globally. And the themes that we kind of pursue out of both, depending on the stage of the company, are around tech-enabled services. So IT services, BPO analytics, and so on, are around software and are around digital. So core digital, or what you call consumer internet, internet classifieds, or e-commerce, and so on. And in the buyout fund, which currently we're investing Apex 10, we do buyouts, as you would understand it. And for growth, we do growth. And in our case, we keep the team separate. There's a lot of cross-fertilization across the two teams because there are synergies. One team finds an interesting theme or an interesting company. If it's not the right fit, they pass it on, and vice versa. But in our case, we find that the skill set is a little bit different. The cadence of deals is a bit different. The places you source is a bit different. The way you add value is a little bit different. So we keep them separate. We have separate tools also of our operating team around that. But it's really whatever works for your organization. And that has proved for us at least to be a very successful model. I would say over time, over the last 10 or 15 years, if I track the proportion of investments across platforms going to these three subsectors that I described, for example, it's just the curve has gone one way. And it's no surprise, right? Those are significant growth sectors around the world, not just in India. They're disruptive to more traditional businesses, as Nikhil had talked about. And so, you want to use an Americanism, you want to skate to where the puck's going, not where it's just been. And that's how you kind of position your business for the future. At least that's our belief.
Thanks, Shashank. But an interesting thing you kind of mentioned about different pools of capital for different specific opportunity, and so maybe moving away from just pure sector, but across the entire capital structure, right? That's the other kind of evolution of private equity we've seen. I think from small ticket equity investments to private equity doing structured equity, structured debt, looking at wider pools. Apollo's kind of been doing a lot of that across the world. How do you see that kind of coming through to India over the next decade, perhaps?
Well, I kind of relate to what Renuka was saying about doing everything within the same pool of capital, and in a way, unlike Apex, started off as a venture fund. We started off as a credit distress fund, and we've taken that DNA and gone from there to natural parts, which we are comfortable with, right? And I kind of go back to the 2009 crisis. And what happened was traditional banks sort of retreated from the credit markets in a pretty big way. Real estate markets saw big turmoils, and all the traditional institutional investors sort of went away. And because private equity was flexible and opportunistic, they ended up filling the void. And what you now see is private equity firms have established very, very large credit businesses. If you look at us, we are about 80 billion in private equity, but 350 odd billion in credit. And credit is a much larger market than private equity. And what came naturally to us is cash flow analysis. We've taken that to structured debt, MES, operating debt, sovereign debt, across the entire pool of capital. And now what we are seeing is LPs who are trying to make a 6-7% return when treasuries are 1-2% are struggling to make that return, and they're not solving it just through alternatives on the private equity side, but also all different aspects of credit. And what's happening now in India is those same companies, whether it's Apollo or Bain or Blackstone, who build big credit businesses, they are coming to India with that product for India. And similarly, I'm sure all the homegrown private equity firms will build their own credit businesses. So the same void we saw post the Lehman crisis in the US, you're kind of seeing here with the public sector banks having difficulty, with all the challenge with the NPAs happening here, with the mutual funds going out of business in some aspects. So that void will eventually get filled in by these alternate providers of capital. And so we at least look at ourselves, and we're not really a private equity firm anymore. We're like the alternate asset manager, as we call ourselves, because credit is a bigger business for us. And again, let's not forget, this credit business has always been in India. When we started in India, the private equity market was 6-7 billion every year, and the promoter financing market, which is basically holdco financing, was a 20 billion market. So there was a very large market in India which existed. It was done by the banks, but now it's increasingly being done by other pools of capital.
Interesting. I think so. You're right. I think different ways to kind of approach that, and you're right. I think you mentioned about debt and different parts of debt. Neha wasn't able to join eventually, but actually she was talking about a similar theme of, interestingly, large number of new funds coming, right? Because in their case, they also have to wear the LP hat in India, and large number of different strategies coming up across not just stress credit, but actually performing credit, and they're kind of backing that as a big theme as well to some parts. So just kind of strengthening the point you just made, perhaps. The other the other kind of theme which is about away from technology is the whole kind of COVID, and around that, how are in the shorter term, perhaps, right? How are fund managers, how are global ICs seeing seeing this impact? So do you see that kind of over the next couple year, 2 years, people kind of being how is India being viewed on that perspective, or investment opportunities being viewed on that? Maybe Nikhil, I kind of maybe start with you, how you think about that.
So I think, as I mentioned earlier, there are a few themes that we are pursuing in particular, and we believe that there is a tremendous opportunity to deploy capital in India. I think Renuka summarized it well, that this is the time for private equity as a source of long-term, stable, patient capital who can actually help companies grow and realize their potential. So from that perspective, we are very, very, very gung-ho on India. And we expect to deploy a fair bit of capital. In the 2 years that we've been in India, we've deployed a fair bit, and we're looking forward to deploying a lot more. So I think the desire is very much there. Obviously, COVID is a macro dislocation, which is obviously really sad from a human perspective. But it does create a lot of opportunities for private equity to sort of buy assets that that you can potentially, I think, obviously in our business, when you buy an asset, valuation is important. Obviously, then you subsequently create value. This provides us an opportunity to buy asset at reasonable prices and then be able to add value and hopefully make money for our LPs over time. So I would say, I think the IC, at least in our case, is very focused on India, big opportunity, and opportunity to deploy lots of capital.
Thank you, Nikhil. But on the same point, maybe Renuka, your perspectives from you, how LPs also particularly seeing this disruptions in India, and particularly opportunities to make in India, and greater there's post COVID, there's a lot of views that global supply chains will perhaps become more localized, and we've seen some parts of that in maybe pharma, etc. But as a broader theme, you think that's a story which LPs are willing to back for India today?
So, to be honest, we have not seen any opportunities around those themes, which are beautiful themes and should happen. not just yet. And also, we have to remember that in the long term, for anything to be sustainable, you have to be the most competitive producer of whatever you're producing, whether it is specialty chemicals or fertilizers. So we in multiples are unable to establish this early that somewhere there is this big supply chain shifting that is going to happen. I think there are some traditional industries which will see a turnaround, and we saw that happening in the auto industry before the before the second wave. But speaking on the pandemic, I would say that I completely agree with Nikhil that from a humanitarian standpoint, it's a terrible thing. It breaks all of us emotionally. But the private equity funded companies, in fact, will benefit from this because arguably they are the better companies. That's why they got picked up by private equity. And B, if they need any infusion of capital, the private equity players would in fact infuse capital. They have used the pandemic to also very tightly manage their cost structure. Many of them have pruned themselves extremely effectively, and some of the changes, as I see, are permanent changes. These costs are not coming back. Four, pandemic has resulted in severe acceleration of technology, and we are looking at how do we deploy technology faster than what we would have probably done in the pre-pandemic, because you just want to substitute human resources with as much of I would say technology, both for cost and for risk considerations. So all of this will make good companies much stronger, and they would operate in a slightly cleaner, as in less competitive environment, right? Some of the weaker players who tend to typically queer the pitch by lowering prices or giving unfair trade terms or doing some shortcuts, those players would actually wane, leaving the marketplace in a more level playing field, and the stronger players will become faster, will become bigger, and more valuable. So there is really no case for decelerating the pace of investment on the backdrop of pandemic. All of us know, while we do not know exactly when and how we will come out, there is no doubt that we will come out. And there is also no doubt that India is a very high growth economy. So there is no deceleration of investment pace. But exactly what Nikhil said is what I would like to reiterate, that digital adoption, digital threat, digital savviness of every company that we invest in, whether in traditional businesses or new businesses, would be a prerequisite, because you don't want them becoming extinct. And talking directly to your question on, are we looking at, many deals which are speaking to this theme of supply chain reengineering? No.
That's a good positive outlook there, Renuka, and coming from you, I think that's obviously heartening to hear for everyone. But you've spoken about disruptions to technology and how private equity approaches it. Yeah. Okay, so we've also seen a large uptick in capital markets. Big pickup in SPACs in the US. SEBI kind of looking to look at that in India. So does that come out? Does that become a part of deal making? An integral part of deal making? Provide potential, of course, opportunities, but that also become a potential threat. But maybe just before that, Harsh, from your perspective, how do you see that as within the whole regulatory framework? Anything interesting kind of coming up there, or themes for private equity here? Harsh, just need to unmute.
Sorry, I think what's been encouraging is that there has been a wider regulatory thought process around what it would take to provide exits and to founders as well as investors, and also these champions of our emerging champions of our industry and our business, for them to be able to establish themselves globally and list themselves and have a have a sort of flagship presence. And I think that's probably part of the natural progression of industry in India. So we are seeing, of course, the possibility of overseas listing, although that's still working its way through. We are seeing some very large IPOs come to market. I think SEBI has also been a bit concerned that the quality and nature of opportunities in the public markets for our public institutional investors, and also our public investors, retail investors, also needs to grow. So I think there is some thinking at SEBI's end to see within the remits of what is consistent with responsible regulation, how that can be encouraged. We'll see where the SPAC, although obviously it's already taken off in the US, and then the SEC has recently issued some kind of missive on SPACs, which have caused people to have a second thought right now. It was still early in the cycle in India. We've only seen a couple, 2 or 3, follow the SPAC route. We'll see. Maybe our own capital markets will embrace the idea, but it's still early days. I sense that the preference from the regulatory quarters would be to have listings in India, with the option for some types of companies to list overseas. So we'll see where that heads. But I think the bottom line of what I'm saying is there is a general sense of encouragement for these kinds of businesses to list and provide opportunities to investors in Indian markets.
Shashank, from your perspective, do you see SPACs as emerging as a threat to buyouts, or particularly, your spaces?
Look, there's a wall of money there, right? I think the fact is that when the pandemic hit, originally back in March of 2020, central bankers around the world decided that they needed to come to the rescue of all sorts of assets and markets and so on. So there was an enormous amount of both fiscal and monetary stimulus that was given, and that's working its way through the markets globally, not just in India. And the net result of that is you have this very strange sort of dichotomy where, on the one hand, for example, in the second wave in India, the humanitarian cost is huge, and we all are dealing with close friends, family, colleagues who are really struggling, hospitals overloaded, etc. But the market continues to rise. So there's almost a disconnect, if you like, at some levels between what's going on around us and what's going on in the financial markets. And SPACs is just an aspect of that. I think, is it a great time if you have an existing asset? Is it a great time to seek liquidity, potentially through the SPAC route? Absolutely. I think 1 or 2 of our companies globally have taken that route. SPACs are very, very complicated, especially US SPACs are very complicated for Indian headquartered or Indian listed companies to do. But essentially, the tax complications and the RBI FEMA complications basically make it nearly impossible. So outside of some special situations, we saw obviously a SPAC with Renew Power, but outside of some special situations, I don't think that you're going to see necessarily a flood of these coming, because when there's a lot of excitement, but when you start to get to the actual fine print of how do you make this work and how long the regulatory process takes in India and what are the hoops you're going to have to jump through, essentially SPAC holders in the US, because you have a finite period of time in which to get an approval done, probably won't be able to take advantage. And there may be special situations, companies overseas, shareholders are overseas for the vast majority and so on. Yes, maybe, but I think it's lots of excitement, lots of people looking at it, but I don't know if it's going to be an option necessarily. But in general, is it the end of the buyout industry? No, absolutely not. By the way, buyouts everywhere are very, very expensive, including in India. So the fact that the fact that valuations are high, SPACs is just an aspect of it. And I think Nikhil and Utsav and some of my other co-panelists talked about it. You have to figure out what you want to pay for something. How do you make money having paid a certain price for something? And SPACs is an aspect of it.
Thank you for that perspective, Shashank. Any closing comments before we kind of wrap up? We're almost out of time.
Maybe I pull in what a lot of my co-panelists have said. I think, look, the main point of private equity, it's long-term and it's risk capital. And the beauty of it is, we can time entry and we can time exit as private equity investors. So the evidence over many, many cycles in the past has been that private equity as an asset class has really performed well for exactly those reasons. And I think Renuka kind of made that point that, the pandemic and the disruptions and dislocations we see in the markets are actually playing to our favor. So, personally, I would be very, very optimistic and positive for the outlook of private equity over the next 5 or 10 years.
Great to hear that, Shashank. Yeah. Absolutely. Please, yes, Renuka.
Yeah, being a Desi fund manager in a sari, I have to say that, I would like to see the government do a lot to channelize domestic savings and also money from domestic insurance companies and pension funds into this asset class. If Shashank is bringing so much money into India, it is for returns, which are equally good for Indian pensioners. So any amount of noise we make to say that let Indian insurance holders and pensioners and Indian savers benefit from this growth would be insufficient. So I would just record that as a serious wish and a serious intent from the industry.
Absolutely fair point, Renuka. I think we'd love to see greater amount of domestic capital flowing into alternative assets. So thank you, everyone. I think it's been a great session. It's been a pleasure to kind of have you all on the panel, and we're all looking forward to an even greater growth in private equity over the next decade.
Thank
Likewise.
you.
Thank you.
Thank you.
Thank you.
Great meeting, everybody. Yeah.
Thank you.
Absolutely. Thank you to all of our panelists, and thank you, Asang, for moderating that brilliant discussion. If you look at the brighter side, the pandemic has truly emphasized that, well-capitalized and supported companies are the ones that are going to grow faster than businesses that need to repair their capital structures. And I think as a result, 2021 may be one of the best investing periods of our generation. And now it's, before we move on to our next session, I want to once again thank all of our partners, our presenting partner, Trilegal, co-powered by MIDC, Maharashtra Industrial Development Corporation, and our associate sponsor, CoinDCX. Thank you for all the tweets that are coming in. We're tweeting, we're live. Please don't forget to use hashtag MintIIS. We also have a super interesting factoid that's playing out for private credit on your screens now. Clearly, India provides one of the biggest opportunities for investing in private credit, and the expectation that 2021 will be a strong, if not a record year for the asset class. Market fundamentals and research already point to healthy sector growth. Let's understand how the private equity market will continue their dynamic but upward trend in 2021 by welcoming our esteemed panelists for our next discussion. Venkat Ramaswamy, Vice Chairman, Edelweiss Financial Services; Srini Srinivasan, Managing Director, Kotak Investment Advisors; Indranil Ghosh, Managing Director and India Head, Cerberus Capital; Kalpesh Kikani, CEO, Piramal Alternatives; Anirudh Sen, Partner, Trilegal. This discussion will be moderated by Nachiket Nayak, Head Corporate Lending, Arca FinCap Limited. Over to you all.
Okay, thank you everybody, and welcome to this session on private credit, one of the new emerging asset classes and much looked forward to asset class. We have a star-studded panel and people who have been in the news of late for various transactions that we have done. So let's get into their mind and try and get a sense of what are they up to, what's driving them, and where do they see this year going. Just to start the discussion, let me give you a backdrop of where things are placed, the way I at least see them, from the conventional markets that play credit, right? You've got banks, which have traditionally stuck to capital expenditure, working capital funding, which they continue to do, all the more risk averse in the current environment. You've got NBFCs, who are the jokers in the pack, actually playing private credit by way of all the transactions that they used to do. Things pretty different over the last 2 years, where they've gone back to the old model of trying to, and I'm talking about more the corporate side of credit, trying to play the more conventional opco cash flow, plain vanilla financing, boring transactions, very similar to banks. And then you've got the mutual funds, where the credit risk funds tried to dabble into the space, but again, over the last year, with their own challenges, kind of gone into a pause mode. So with that backdrop and the fact that there is a fair amount of deal flow emerging, which can't get addressed from conventional markets, we have this new space opening up and settling in well by way of how private credit is getting played and participated. With that backdrop, I just want to open up the discussion and start with Srini actually, to give us a sense of where he reads where corporate credit is placed currently, given the pandemic, given the multitude of regulatory interventions by way of moratoriums, by way of NPA classification on a pause mode, IBC on a pause mode, OTS or OTR having been put into place. And now, of course, after all that is through, we're in the midst of the second wave. So with that sort of a backdrop, Shini, wanted your sense on where do you see corporate sectors placed and what's in store for us?
You're on mute, Srini.
I'm saying Nachiket sitting at home for nearly 18 months and reading through this alphabet soup of various things. It's really hard to cut the clutter to decide what you really want to do. But having said that, I think you put the background correctly. First of all, you talked about mutual funds getting into the private credit space, a space that they ought not to have got into. And that actually resulted in what I call as the giant sucking sound of money going out of anybody who wants to be in this business on a levered basis. So those two combined factors was the tsunami. And on top of that, we now have the COVID. Look, I think that, notwithstanding all the, alphabet soup moratoriums that we have, the reality of it is that it's very hard for businesses to operate at suboptimal levels for very long periods of time. We had a very hard shutdown. We now have a soft shutdown. We don't know whether we will have another hard shutdown or a soft opening. It's very, very uncertain. It's great news for people like us because we now get to pick and choose the businesses that we want to put money to work in. But notwithstanding anybody saying that everybody like us works at 24% IRR, there are no businesses which generate 24% year on year for 5 or 6 years. If such a business were to be in existence, everybody would be in that business. So there is a lot of risk associated with what we do. And I think half the trick, given the nature of the environment today, is to pick and choose your battles. So we spend more of our time trying to pick and choose the battles that we want to be part of and less time trying to go and find transactions. I'll probably stop here and let I can see Venkat smiling away. So you can take it on from here.
Sorry. Nachiket, should I go?
Yes, absolutely, Venkat.
So I agree with your thesis and Srini's thesis. Reality is that historically NBFCs, mutual funds, and in a very, very small way, private credit funds used to play in this market, which is, real estate credit lending, corporate credit lending, as well as special sits investments, right? NBFCs post ILFS, I think their own ALM and liquidity related issues, plus the leverage in pretty much every balance sheet, every NBFC, led to them not being able to be part of this business in any meaningful way. Mutual funds, actually, Nachiket, I have no idea what they were doing in this business. They have no business being in this business, right? So, and luckily, not too much harm got created, and that left the private credit funds who provide long-term and, in my view, patient capital, and which is also flexible, right? So you can structure your cash flow and returns according to the cash flow of the investee company. And this happened in the Western world post GFC. So in my opinion, India is having the post, with respect to private credit, it is having the post GFC, right? So globally, most of this kind of lending has moved to funds over the last 12 years. And I have a feeling the same thing is going to happen in India. And we are just lucky to be, this Starcast is lucky to be in here at this time in this asset class's life, my opinion.
Okay. Thank you for that, Venkat. Kalpesh, coming to you, given that you all in your present avatar are one of the newer kids on the block in that sense of the term, but of course you're a dyed-in-wool veteran in this space. Where do you see the role? And we'll come to that specifically into themes and sectors in the second round, but at a macro level, where do you see the space for private credit currently?
Thanks, Nachiket. Firstly, for everybody who's on, I hope all of y'all are staying safe, staying indoor, and it's a tough time for most people, most families, friends. So hopefully all of y'all are being safe. I know Venkat just told us he's just taken his second jab. Everybody who can, please go ahead and take your jabs and make sure that we minimize the risk to ourselves and to our near and dear ones. Nachiket, to your question, my thought process on this asset class is it's no longer new. We're approaching about $1 trillion of AUM globally in this asset category, which is like a serious asset class. I would think maybe real estate is bigger and private equity is the biggest. So we're still number 3 in the pecking order of alternatives, as alternatives get to about 11 trillion and private credit, private debt funds add up to $1 trillion. We are like a serious area of the alternatives market. I think focus for me at least has to be around flexibility. And both Srini and Venkat touched upon this, that we had other players, other formats of providers of capital, or what the FSB calls, I think, EF2 assets, right? Those EF2 assets are unique to India, where we have such a high proportion of EF2 assets, where you have levered balance sheets providing this kind of credit. It doesn't happen in most of the countries in the world. So you really need to have a format which is more traditional in other parts of the world, which is now emerging. We obviously have, Kotak has been doing this for a while. Edel has been doing it for many, many years. But we now are seeing bigger platforms emerging who can be flexible. I think the magic word here is flexible across the capital structure. So we, for one, attempt to start our life right adjacent to the banks. We provide senior secured OpCo credit for mid-market companies. So that's where our life starts. Our loans look very similar to what a bank loan would look like. We obviously don't provide cash credit or non-fund limits, etc. But barring that, we resemble bank credit very, very closely. Unlike the bank relationship manager who's out there to make a relationship ROE by making float income, FX income, etc., we have just a single monoline product from which we make our money. So we better get our act right, because we have no cross subsidies If we underwrite a credit wrong, we don't make any other monies on our business. So we start there. We do go up the risk spectrum from there. So we do all other elements: preferred, converts, mezzanine, opco, of course, holdco financings, unitranche, all the way to distress, where we make obviously the highest amount of return and we take the highest amount of risk. So my view is, as private credit providers, if we have to be meaningful for India Inc., we have to get our act right in terms of being flexible in our mandates. It is tough. LPs love to bucket people into very tight mandates, and that's really our job as people who raise the capital to negotiate what are appropriate mandates for our country. If we are able to do that, we should be able to play a serious role. As you know, people, players come in, go out. Both my colleagues talked about NBFCs, mutual funds. 100% agree with them. I think this is the correct format in which we need to be playing this asset category. And the skill will be our ability to negotiate mandates which are appropriate for our country.
Okay, great. One follow-on question for all three of y'all, given that pretty much all three of y'all are in fundraise mode. What's the general sense that you get from investors, both from a India perspective and from a private credit in India perspective? Why don't Kalpesh, you go first, then Venkat, and then Sri?
Okay, so the piece which is the toughest is the piece which is most adjacent to the bank lending piece, right? The post-tax, post-FX return just doesn't stack up for most LPs. So that is the toughest piece on how do we articulate what is the right return for that risk. So we have that capital and we are growing that capital, but it is the toughest piece, clearly. If most LPs will ask you, if I'm going to take emerging market risk, I'm going to take 4-5%, I'm going to lose on the currency. Really, why should I be in this asset class at all? And then if you overlay on it some amount of credit losses, then the asset just doesn't make sense. So that, I think, is the toughest. The second piece, which is the mezzanine or the hybrid credits that we do, there I am finding a lot more traction. A lot more people are seeing that as similar to what they do in other parts of the world. Again, there is a desire to have an India premium, call it 2 to 4% over what they make in other markets, and that just doesn't exist. So that's
I do think that over the last 12, 18 months, I am at least optimistic and bullish about the Indian LPs, because the search for yield has also reached India, in the sense that banks are providing lesser and lesser returns on the FD to customers. And if you do not, or if you have taken enough risk by investing in the stock markets, and that is a different pool of capital. For capital that you are looking to earn some steady yield, I think currently instruments are very far and few in between, right? So I think this could be an asset class that could be interesting for high net worths as well as insurance companies, one, as soon as regulation allows it. Currently, regulation doesn't allow for insurance companies to invest in this. So that will be something that could potentially be interesting. And as far as LPs are concerned, I think reality is the same thing is dramatically true also globally, right? So 85% of all corporate bonds currently trade at less than 2% in the global market, right? So even if we deliver 14% kind of returns, and that could well be 7 to 9% sort of dollar returns, I think they are good returns. So it is like Kalpesh is saying, I'm just hoping that the all of us stay steady and there is a lot of capital that needs to get deployed. There is no yield available in most parts of the world. India is definitely one of the few large economies, and I'm not speaking about small economies, right? So there are a lot of small economies where you can get this kind of yield. But large economy, in the sense there are not too many which can provide this kind of steady long-term yield, and the market opportunity is large. And so I think these are interesting times. And if, like Kalpesh said, there is capital available across the spectrum. Yes, at the lower end, it becomes tougher and tougher, but that is a process of education, in my opinion.
Anything you want to add to that?
Not really. I think availability of capital is not an issue, but as both of them said, it's a question of how you articulate the risk reward in India. And I generally do not buy the argument of currency risk with LPs. I tell them that the reason you are looking to invest in India, somebody in your system has already taken that into account. So don't bring that in the calculation in terms of what is the net return you're going to make. And then let's have a conversation. It doesn't go down well with everybody, but at least it's a starting point. You know, it's my opening sort of cards of negotiation. But the only good news I can say is that I foresee that given the size of our economy and the size of the opportunity, you will have the fund managers or people who are raising money will have the pleasure of negotiating with many more LPs than they had in the past.
Cheers to that. Okay, Indranil, coming to you as the representative of the foreign fund manager in this space. Just wanted your sense, given that you all look at transactions across the spectrum from a peer comparison perspective. How does India stack up? How does your system, for example, look at India vis-a-vis other countries, and where do the risks and rewards kind of stack up for someone who is not just an India player in that sense?
Sure. So very similar thoughts to what Venkat, Srini, and Kalpesh have articulated. On the demand side for Indian paper, private credit, while as Kalpesh mentioned, might be one of the in the third bucket in terms of size, but it's growing pretty fast. Just as a number, over the last 2 years, global fund managers raised close to $300 billion of private credit capital. And this needs to be deployed. Obviously, a large chunk of this is meant to go to the US and Europe. But increasingly, given the search for yield, people are trying to sort of blend up their returns by coming to markets like India. And India, fortunately for us, is one of the last bastions of yield where you can at least get a reasonable sort of reward for the risks you are taking. Having said that, the risk reward perception for a country like India still remains a little bit heightened. And to that extent, there is a premium that needs to be sort of earned over and above, let's say, a European credit transaction, which might have similar dynamics. That obviously reflects in the pricing that we see for this product in the Indian markets. Added to that, as Kalpesh mentioned, is the cost of hedging. Depends on what strategy each and every firm follows. Obviously, Srini clearly is one of those lucky ones who doesn't need to hedge, but mortals like us probably have to. And then there is a withholding tax sort of implication. So all of these costs do add up, and they obviously end up with the issuer bearing it in some form or fashion. However, this is all sort of improving. I think various ICs, whether it's for a GP like ours or LPs, who we just spoke about, are recognizing that the dynamics might be not too different for India versus the rest of the world. And the reality is that there aren't that many high yield opportunities in the US and in Europe, given what central banks have done there, right? So perforce, many investors like us are spending a lot of time in India, as you've probably noted. On the supply side, again, this was mentioned, but NBFCs and mutual funds have created a gap. Not all of that gap can be filled up by alternatives like us, but there is definitely more sort of paper available and lower competition from outside this fraternity, right? I mean, this fraternity is getting crowded, like I mentioned, but from outside the fraternity, there is a lower competition, and that obviously helps. So we think we will continue to see interesting transactions in India. Almost every large GP is already focusing on India, has probably done at least one trade. And a lot of them have local offices, which they will continue to build and invest significant capital. So this will continue to be a corner of the Indian market, which is the smallest from alternatives perspective, but we think it will grow quite a bit.
Okay, thanks for that. Just one more follow-on question to that. Maybe a bit too premature, but how are ICs viewing India post-COVID? Is there a distinction now coming between countries and geographies, or has COVID in any which way, like I said, again, maybe a bit too premature, played a role in kind of identifying more or lesser risk in certain economies?
So I think, I mean, there is a little bit of a two-part answer to this, right? If you were to ask me this question like a month back, I think ICs were, quite surprised that India, without the, the fiscal support that the rest of the world has seen from their, governments and central banks, has managed to bounce back and is sort of, starting to show revival. So the resilience definitely surprised, some of our ICs, and people were super gung-ho. And in the middle of this, pretty much everyone in this room ended up doing sort of sensible transactions, and so did our peers. So, there was ability to deploy capital as well, which I don't think was the case across the board, across several geographies, where central banks basically took the trade away. So both from a economy's resilience perspective and ability to invest, ICs were very, very enthusiastic. However, I think what we have seen in the second wave right now as it's unfolding, the challenge really is there is a lot of press. And I think the reaction that ICs have right now is, what's really going on? What will be the extent to which the second wave will last? And how will the country bounce back from, another blow? Again, at least from our perspective, we think, yes, this is obviously, the numbers are worse than what it was last time, but I think the economy is going to continue to be resilient once we've dealt with the virus problem. Whether it takes us 2 months or 6 months, obviously none of us can answer, but once we fix this, I think the economy bounces right back, and pretty much everyone across the globe realizes that, and is looking at this as an opportunity to deploy further capital into India.
Okay, excellent. Good to hear. Okay, coming to Anirudh, you're the magician who makes things happen. Where have you seen the challenges from a legal and regulatory perspective, and are you seeing any change by way of the way regulation is keeping up with the requirement for this tranche of capital, and also, like we have seen, a fair amount of transition in the legal system to enable private credit in general? So just your opening perspective by way of the regulatory and legal environment being supportive for private credit to mushroom.
You're on mute, Anirudh.
You're on mute, Anirudh. We can't hear you.
Apologies. Sorry. Hi, Nachiket. Hi, good afternoon, everyone. So, Nachiket, interesting question, and I guess two aspects to really consider from a legal and regulatory perspective. I mean, first of all, the sort of regulations that exist upon entry, and that obviously varies depending on the type of investor and the type of sector that you're investing in. Now, what we've seen obviously over the last year with the IB IBC being suspended, there were obviously number of ongoing IBC matters that were continuing. But equally, we saw a profusion of capital, both foreign capital as well as private domestic capital, go into a number of special situations deals, real estate backed financing, as well as a number of transactions that were actually driven by by the liquidity crisis that a lot of the NBFCs are currently suffering. Now, at an entry level, I think it'll be fair to say that a lot of transactions actually did take place, and while there are obviously certain tweaks to regulatory frameworks that can come about, and a few of them that, to my mind, would make life easier. First of all, should the list of non-performing, the list of acquirers that can buy non-performing loans be broadened, right? So, as of now, only ARCs can acquire NPLs. Should that increase to, other foreign investors? Should that increase to other domestic fund investors who should have the ability to buy NPLs without necessarily having an ARC? Right. Second, should there be any extent of regulation to the distress market at all, right? And if so, what regulation should that be? And the RBI is actually, got a committee in place at the moment that's looking at a substantial overhaul of ARC regulations, right? And that could be interesting because that's been a threshold level issue for, a lot of private capital, and especially the foreign capital, to find its way to do distress trades. I think at an entry level in India, the challenges generally seem to be arbitrageable. Where it invariably gets difficult is on exit, right? And that really boils down to the enforcement environment. So what are the types of courts that are available? How easily is it possible to enforce security? Can you enforce security over land or enforce security over share pledges quickly? And that's where really there are clearly some administrative hurdles and holdups that make life difficult for investors. And from a legal and regulatory perspective, that'll be the interesting thing to see over the next 4 or 5 years, because clearly there's a demand side and there's a supply side to the need for private credit and all the factors aligning, which is what all the gentlemen on the panel have rightly alluded to. But ultimately, if India's enforcement environment is not able to mature in a similar way, a lot of that growth might get stymied. And to my mind, that's the biggest fix that needs to happen in the private credit space over the next 3-4 years.
Okay, thanks for that. And apologies, I think technology has its perils. I think somewhere it doesn't seem to like my face and it's just blanked me out, but hopefully I'm audible. So that shouldn't matter. Okay, let's get into round two and get into specifics around themes that and sectors that we have seen in activity in the coming year, and hopefully what we should see in the coming year as well. I like to break this up into three buckets. One by way of the more conventional distress space that everyone's talked about, and I like to restrict that to a NPA pre-IBC admission sort of space where we are seeing a fair amount of activity with one-time settlements, etc. Something before that, what I would call the stress space, where you can define it by way of special situations, turnaround strategies, last mile rescue funding, etc., etc. And then, of course, the growth phase, where companies in early stage have yet to get into a more bank ready sort of mode by way of senior secured funding ready. So if I was to chase those three themes, and I start with Venkat, you on the distress side, what's the kind of activity that you are seeing on that space? Are you seeing a lot more preference for settlements outside of IBC? How are you seeing this kind of space perform, given that a lot of activity in private credit seems to be happening in the stress/distress space?
Thanks, Nachiket. So in the pre-IBC space, so when you think about, okay, we have done transactions both in the pre-IBC as well as post-IBC kind of situations. But we do, in our preferred area, which is manufacturing companies, we have seen a lot of companies go from stress to distress, primarily because of lack of availability of working capital. Banks in India have a strange sort of uh, methodology that they follow, which is they clamp down on working capital as soon as a company goes towards stress and is going towards becoming an NPA. So, which in a, and I'm sure that is not the intention, but which accelerates their process or their journey of going from becoming a stressed company to a distressed company, right? And so in our experience, and I'll give you 2-3 live examples. We invested in about 3 odd years ago in uh, in a paper company in the north of India, and the company had got to zero EBITDA because the banks had sucked out pretty much most of the working capital, and there were 5,000 people who were employed in that business. They had not been paid for little over 3 months. And I'm telling you, Nachiket, we didn't put a whole lot of money initially. I think we must have invested 200, 250 crores. And the company today, or in the end of March of this year, ended up with around a little over 600 crores of EBITDA. And so there was actually nothing wrong with the company other than EBITDA had completely, or working capital had completely gone away. And paper is an import substitute, or India imports a lot of paper. We ended up saving 5,000 jobs plus some 3,000 odd crores per year of foreign currency, and also making a good return, right? So we recently, Indranil and I, Indranil's firm and Edelweiss did a transaction in a cement company. Similar situation where there is a third investor, and 3 of us have got together and bought out the existing debt holders. And there is actually not a whole lot wrong with that company, other than the fact that its repayments have come sooner than their cash flows have come about. And there is a clear plan. They are in a position to pay interest and things of that kind. And we are able to do a sort of OTS funding of that company. And in my opinion, if these same companies had gone into IBC, I think resolution could have taken up to 2 years. Plants would have got impacted. Definitely people would have got lost jobs. And the end outcome may not have been too different, in the sense that the banks would have probably got the similar amount of capital back, but it would have created a lot more disruption for the company and all the stakeholders associated with the company. So, in my opinion, I think pre-IBC is a good thing, and even in IBC, I think the government is thinking of pre-packs, and that will be sort of almost immediately seem and feel like pre-IBC deals only. So I think there'll be more of this, in my opinion, Nachiket.
Okay, that's great to hear. Srini,
If I can just add, sorry to interrupt you, Nachiket.
Sure, go ahead,
Just
Kapish.
to add to one comment that you made, I think the end outcome, if indeed things play as per the current manner in which they are playing, will actually end up being much worse for the existing stakeholders. It won't end up at being the same level. There are obviously a few IBC cases where you have, better outcomes, but those are very, 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 very few. So I think what you just described is probably the best outcome for all stakeholders. It's just challenging for them to convince their internal processes and their auditors and the CBI or whosoever to say this is the best outcome possible. That is the bigger challenge, I think.
Yeah.
Sorry to interrupt you, Nachiket.
Not at all. No, absolutely. And I think somewhere playing to the optics at times drives transactions, which is really unfortunate. But so be it. That's the way India works. Srini, coming to you. You all have done a fair amount of what I described as assets in the stress category, where probably, if I can define it, companies are SMA 1 but yet to become NPAs and are seeking solutions to stop them slipping into NPA category. What's the sense you're getting by way of deal flow in this category and the kind of activity we can expect?
There's a fair amount of deal flow across the buckets that you mentioned. Obviously, given the fact that if the company is already doing reasonably well and it has a cash flow mismatch, and for the reasons that Venkat mentioned, if the banks are not being accommodative or adjusting, then it actually provides us an opportunity to tell the company, you know what, ask the banks to go home, we will pay their money back, and I'll give you more flexible capital. 3 of the transactions that we have done is exactly those. For example, DCW, which is a listed company, the company had not defaulted. It's just that it was clear that the maturity profile of the existing debt will most likely not meet its cash flow generation projections. And then COVID, etc. happened. So the company did not want to default. It was not even an SMA 1 and SMA 2. It was actually a performing loan for the banks. But the company said, listen, I don't want to go down that path. And I know how these banks behave in India. They will not support me the moment I, fall behind. And they wanted to avoid that. So I call that a very proactive management. And the very fact that the management is coming forward and saying, listen, I know that I might face difficulty and I want to refinance right away, shows the intention of the management. So the moment I heard that, we said, okay, this is the company that we have to back because the management has every intention to pay. If the business did not do well thereafter, that's my judgment call. But where the intention is right, you got to go there and give the money. And I think the banks, by their attitude, are actually giving up these kind of low-hanging opportunity for credit funds like us. I'm not complaining. I'm pretty happy about it. And I hope there are more guys doing that. So that was one situation. Then we have this other strange situation. Even if the company has turned around, started making money, simply because the liability side of the balance sheet says this is a quote unquote a CDR loan, the banks will not give new money to them. That's another opportunity for us. Now, these are all, so we went and funded that company as well. I think the point that I'm trying to make is that opportunities in India come in strange ways. And they come not only because of financial distress in companies or through IBC, but the greatest opportunity that I'm seeing right now are coming because of regulatory restrictions and mindsets, which are dogmas which they can't get out of. So the existing system, 80% of the credit providers in this country, who are the public sector banks, cannot get out of the erstwhile dogmas. That's opportunity for us.
Yeah.
Then the balance 30% is the Reserve Bank of India does not allow banks to do a bunch of things. That's opportunity for us. And it's only the balance 40% where the companies have got into trouble, which may be either SMA 1, SMA 2 or IBC, which are, so you got to have a flexible, I think Kalpesh mentioned it absolutely right. He said, you got to negotiate a flexible mandate with your investor. If you get your investor to bucket you and put all kinds of conditions, you can't do this and you can't do that, you have to buy only in IBC, then you're not going to be able to deploy capital. Investor needs to understand that here are a bunch of guys who know what's going on in India and who will essentially shoot for opportunities as and when they turn up and not necessarily in a bucket. So long as we protect their capital and we are able to deliver the return that we promise them that we will.
Okay, wonderful. Good to hear. Kalpesh, coming to you, I think there is this category of transactions which we've not seen too much of, which what I mentioned is the conventional mezzanine or growth capital space, where it's an early stage company yet to get bank funding ready. Are you seeing any deal flow in that particular category, or where do you see opportunity on not the stress or distress variety, but actually playing to growth through a private credit platform?
My own personal background over the last decade has been doing most of the stuff which both Srini and Venkat referred to. But in pyramidal alternatives, what we are seeing is indeed this particular asset category that you referred to. There are segments of the market which traditionally banks have not been big players in. So we are currently working with a data analytics company. This is a company which predominantly earns its revenue in dollars, and it has its entire assets are the people, right? The intellectual capital that it has. The company's ability to, and this company has now, I think, about 18 years of operating history. So it's not a startup, right? But this company's ability to access the bank credit market is strangely low. So here's a company which wants to grow. There are reasons why it currently does not want to dilute, and it needs some growth capital. It also needs capital for some of its own private equity investors to get an exit. And these private equity investors are going to make fabulous returns on their investments. So you have this company, which we think is an amazing intellectual property company, where they just don't have access to the traditional credit market because it doesn't fit into the fixed asset cover ratio regime, which the banks are more used to. So that's just one example of a high growth company, very low leverage, nowhere in the stress, distress, SMA world, but which is a great company for us to lend to. So, as I said at the beginning, if you are flexible, if you are able to lend into operating companies, you're able to then also take along with your debt position certain equity positions or hybrid positions or warrants. Each of these give you upside on your overall return. And again, as long as and we have great global LPs. Unlike what Venkat said, we do not have, neither in my current firm nor in my previous firm, we had local capital. So I don't know how understanding local capital is of the need for this kind of a mandate. But if you have large, sophisticated global LPs, which we've been fortunate to have, we do get that kind of flexibility. And so the opportunity for high growth companies who don't traditionally access the debt markets, who cannot have the monthly coupon payment, amortizing sort of cash flow profile. How do they sort of access growth capital? The only opportunity used to be to take minority growth from the PE world, which most of these firms have done. But as we all know, over the last 4 years, we have about $45 billion of private equity coming up for end of life. So you will have a lot of these guys needing an exit. Will all of them get an IPO? I don't think so. So that's going to be a big opportunity for people like us who can provide that kind of flexible capital. So I think it's a huge opportunity in addition to all the stuff that we talked about in stress and distress.
Yeah, absolutely, and hopefully we get to see a lot more of this variety of capital as it becomes an enabler to growth and not just an enabler of resolution. Indrajit, coming to you, by way of, are there any specific sectors? I have seen that you all have been pretty active on the commodity space, on the BFSI space, but any pick and choose amongst sectors that you see a lot more potential in going forward?
So why don't I pick up those two sectors first, and let's talk about some trends that we are seeing there. I think on the BFSI side, the only real consumer of private credit is the NBFC sort of variety. And there too, I think post-COVID, the measures that the government introduced, whether it was the LTRO initially for liquidity and then eventually some of the partial guarantee schemes, have given these NBFCs some breathing space, and a lot of them have utilized it fairly well to sort of simplify and push out their maturities. There will be some of this that will come up for repayment, I think, in the second half of this fiscal. That might cause some turbulence for a few guys, but by and large, I feel NBFCs as a sector is actually doing significantly better than what it was pre-COVID. With ILFS and then DHFL and Altico, etc. happening. There might be a couple of guys who still sort of, have troubles, but I think nothing systemic is potentially likely to come out of that. And even if there are a couple that sort of end up defaulting, there is, I think, a good template in both Altico and DHFL to resolve some of these mid-sized NBFCs going forward. So while we see maybe some amount of opportunities in such situations, I don't think it will offer a host of opportunity. One trade I think which will continue potentially is NBFCs selling their wholesale portfolio, as a lot of them now aspire to go and become as retail oriented as possible. And definitely not the high yield space as was discussed, which people are trying to vacate actively. Not just by sort of letting it run down, but actively selling portfolios. So I think that trend potentially continues. Outside of that, in a couple of distress situations, we think unlikely that much will happen on the NBFC side. Commodities, the other sector that you mentioned, is on a hot streak in India and globally, right? So it's unlikely there will be any special situation, high yielding private credit type situation there. There are a few maybe steel plants, a couple of cement plants which have legacy leverage issues. But I'm assuming those will sort of also get sorted out. So we again don't see much coming out of that segment going forward. One of the sectors where we think there will be a lot of action is real estate. I think that's a sector where traditional sort of pools of capital still remain unavailable to a vast portion of that sector. And even though Resi guys have had a blockbuster, 2020, especially towards the second half. But if you look at the whole year in totality, obviously it got sort of hit by COVID. We don't know what the second wave does, but again, we think that sector will take up a lot of private credit capital going forward. So that's a sector we are keenly watching. And will probably throw up some opportunities for all of us.
Okay, that's good to hear. Anirudh, lastly, coming to you, where have you seen challenges when it comes to execution of some of these opportunities, especially when it comes to things like due diligence, structuring, etc.? Because these are more bespoke in that sense of the term. I just wanted your sense on where have you seen challenges when it comes to consummating the opportunity by way of an actual deal.
Sure. Nachiket, so I'll talk about three specific situations and just, again, picking on some of the themes that everyone on the panel just referred to. So first of all, portfolio transactions, right? I mean, we've obviously seen a number of NBFCs selling their distressed portfolios. We've seen NBFCs selling or trying to sell or package, real estate wholesale portfolios. The challenge with portfolio sales is they keep increasing, I think, is the quality of information that you get in diligence. And that's sometimes because unless you're doing a pure play refinancing of borrowers directly, to basically provide liquidity to the NBFC. The information that's available with the NBFC or the selling lender tends to be suboptimal, right? And very often an investor or a credit fund is in a situation where it's take it or leave it on the basis of existing information. So that's something that we found in the course of due diligence has been a challenge. I think the second theme, Nachiket, is on bank sales. The RBI obviously has fairly stringent guidelines on banks selling NPAs with, public auctions and Swiss challenges and things like that. And, there is a lot of adherence to process and obviously banks feel impaired to sort of strike private deals or to strike swift deals without actually running a process, and bureaucrats do so for obvious reasons. They don't, the CVC and so forth. But we've seen that can sometimes be very, very frustrating. So it's obviously both the conduct and the mindset of the banks when they actually sell, but also the regulation that comes with it in some senses that can actually be constraining. I think lastly, and again, just going on real estate from a legal perspective, very often, what we look at very closely is risk management, and certainly something that we've seen over the last couple of years that's worried us a little bit for investors is sometimes deal timelines are just incredibly quick, right? And while you can do the corporate diligence and you do the structuring, enforcement analysis, and documentation in the course of a deal, what sometimes is suboptimal is the quality of the real estate diligence, right? And that's because you've got to do a deal in a month or two, and there just isn't enough time to fully get to the bottom of title and approvals and a whole host of issues around real estate. So I worry that is an aspect that a lot of players in the sector have ended up glossing over, and it may come back to hurt in the years ahead. We'll see. But certainly one area where there is scope again to improve the quality of information and therefore the underwrite.
Okay. Okay, great to hear. Okay, thanks for this panel. Just we'll go around the panel now for closing comments. And what I want to do by way of each panelist is hear from you all by way of one single thing that you would want to see different in the coming year to enable this space to blossom further. So let's actually, Anirudh, why not start with you and then go around the panel with Venkat and Srini and Anirudh, and then to wrap up with Kalpesh.
Would love to see Nachiket, courts just set up virtually and function virtually as they can for commercial matters. I mean, the government has sort of tried to digitize the entire court system in the last year, and in many ways they've progressed to lengths that we ordinarily never thought they would, and so that's a start. But even now, with the second wave of COVID, we're sort of facing a lot of instances where courts are just shut. There's no question of getting a hearing. Then there are court holidays, and I really feel if there can be some administrative impetus to the e-courts policy of the government and sort of have more virtual hearings and dispose of matters quicker virtually, then that's certainly going to help. Help the entire space.
Okay, let's hope that kind of comes into force, especially like we've seen this year, where it's become pretty much the norm for everyone to operate on an e-basis, if one can call it that way. Venkat, anything that you would want to see different?
Well, my opinion, not just for me, but for everyone, I'm sure, in this panel and listening in, is if the ongoing pandemic could just wither away, or if not completely vanish, I think that would be my number one wish, because this kind of suffering and this kind of helplessness I have never seen in my lifetime, right? So, and I'm sure most of us have not seen in their lifetime, and so I hope everybody continues to be safe and this goes away. Coming to this panel, in the Senate, I genuinely, Nachiket, in my opinion, all performing credit, corporate, performing credit, real estate, distress, you just pick the spot, and there is so much opportunity. In the Senate, and I say this because we run funds across all of these buckets, and we run separate funds across each of these buckets. So we have, unfortunately, like Kalpesh is saying, not been able to get flexible mandates. So we run separately boxed strategies. But reality is, if you ask any of my managers, they will say they have in their lifetime never seen deal flow of this kind. Never seen deal flow of this kind. So there is enough for all of us to do, and times a few more times all of us to also do in India at this point of time. That is the amount of space that is currently available, and so therefore it allows for a lot of picking and choosing and being patient and things of that kind, and finding the right like Srini, I love that phrase, right? So finding the right motive with the borrower willingness to pay is upfront established, I think. So these are all things that will happen to this industry. One other industry obviously is going to do very well because this industry is going up is the industry that Anirudh is part of, right? So all of us can't work without these guys. So it's good for them too.
Yeah, absolutely. Srini, anything you would like to see different, or is it more of the same, like Venkat is saying that there's just water everywhere?
No, Venkat stole my speech on COVID going away, so I won't repeat it. But no, I think the only thing I would, it's a combination of what Anirudh said. I would like to see a level playing field between three providers of capital for distressed assets. There is ARCs, there is funds managed by domestic managers like us, and there are funds managed by international players like Indranil. Today, Indranil can own an ARC and can invest through his FPI. RBI does not allow me to own an ARC, neither does it allow me to invest through my AIF. And that is not a level playing field. And I would like to see that. You don't ask me to fight with my hand and leg tied.
Export of asset management, Srini.
It's like someone said, we've got a lot of Kutumb Deva Bhava by way of being far more welcoming of guests than of us in that sense of the term.
By all means, welcome them, but don't ignore the domestic guys who are getting money from the same sources. Please remember.
Anirudh,
any consolation? I don't want to own a ARC, Srini.
But Anirudh, on the serious note, anything that you would want to see to ensure that the dollars keep flowing in?
Yeah, I mean, obviously there are restrictive rules around FPIs for the moment, right? So primary deals have actually become very, very hard because if you're a new fund, earlier you could just set up an FPI and boom, you could invest. Now you're bound by either the 50-50 rule or VRR. So you either have to set up an AIF and get a renting FPI. And we've actually seen a lot of foreign capital. I mean, apart from the 10-15 foreign guys who are regular here, but a lot of guys who are not committed long term but looking at opportunistic deals actually pass it up. So that, along with the ability to, I think, just buy in the secondary space, and my personal view is that there's absolutely no reason for the RBI to regulate ARCs, right? I mean, their problem is to clean up NPLs that are non-performing. That's a problem with a massively undercapitalized and illiquid banking system anyway. So just take it out. Don't make it harder. Let the foreign guys own it directly. How does it matter? It's not going to become systemic in any way if you look at the numbers, right? I mean, maybe 10-20 billion of the 150 billion is probably doable from a deal perspective anyway. So for foreign capital,
not just foreign guys, the domestic guys too.
And the domestic guys too.
The entire ecosystem keeps talking for foreign guys. And the domestic guys get ignored.
The question, Srini, in fairness, was for foreign guys. I completely agree. I mean, level it out, right? There's too much regulation.
Indranil, coming to you, do you need to pitch anything new to your IC, or do you see they're kind of sold on India already?
I think most global ICs understand the India story, and they understand that this is one of those markets where there is a long-term story where you can do it alone, unlike some of the other markets like China, where you potentially have to partner up, and there are several sort of other challenges. Obviously, there are these regulatory issues that we have all been dealing with. And on the other side of that fence, I have like a bunch of complaints about FPI, like Anurit mentioned. Why can't we own directly these NPLs and so on and so forth? But these things we've all now gotten used to, and FPIs, as investors have understood that they need to do or own or have multiple vehicles to try and access the opportunity. I think there have been a bunch of regulations that have been pending. One of them that comes to mind is pre-packs from a more NCLT perspective. There is obviously, people outside of the ARCs owning bad debts directly. Some of these long pending things, if they can happen this year, it'll be great. If it doesn't happen, doesn't matter. I think the juggernaut will sort of roll on. So,
yeah, fingers crossed for that. Last word to you, Kalpesh.
So thanks. I am going to be more greedy than Venkat is. I do agree with his sentiment that I think it's a good point in time for all of us, and what IG just said, right? The juggernaut will roll on, but just being more greedy, I would say if we can get our act together as an industry, right? Today, if you see the largest alternative asset platforms in India versus the globals who are now operating in India, there is a big gap. So what I would love to see is this being a focus area for the country, and each player who's on this panel, each of them can easily have a $10 billion platform across this asset category, and whatever the government, the RBI, the SEBI, all the key players need to do to focus on that. We need to do that because that is the opportunity which I think is going a begging. The market is there, the capital is there, the human talent is there, but we need to make the most of this opportunity.
Okay, super. Thank you so much, gentlemen, and it was great hearing your thoughts. And here's hoping to number one, like Venkat rightly said, private credit apart. Let's hope that we get back to living our normal lives pretty soon, and see the end of this misery and suffering all around us. So here's to that, and take care and stay safe, all of y'all. Back to you, Team Mint, to keep the show going.
Thank you, Nachiket. And once again, thank you to all of our panelists. I think we ended on a unanimous wish list of having a healthier and a far more prosperous and an easier industry-wise 2021. What I gather is, be it the accelerated use of technology, be it accepting strategic risk, or a continued shift from the traditional private equity, will continue to emerge as a growing sector post-pandemic with great certainty. So that was our power panel. We're going to move on to our next. But before that, we're playing out our next factoid on insolvency and bankruptcy code. Watch it here. So on that note, we're moving on to our next panel on insolvency and bankruptcy code. Question is, what lies ahead? So while IBC was a landmark law that has made a paradigm shift in how banks deal with bad debt, the pandemic led to its suspension for a year. Now, with IBC back in play, with moratorium gone, with the second wave of COVID-19 threatening to disrupt business activity again, will IBC deals come back strongly? Will investors throng back to the NCLT to pick up assets at distressed evaluations, or out of court deals have become more attractive to investors? What has the IBC experience been like for investors? And what more do they expect to make deal making under IBC far smoother and more attractive for them? These questions will be answered in our next panel. Let's welcome our esteemed panelists to your screens. Vishal Gupta, Senior Vice President, SBI Capital Markets. Our Director and CEO, Edelweiss ARC, Shyam Maheshwari, Partner, Eris SSG Group. And the moderator for this discussion is Srinath Sridharan, Independent Advisor to Boards and Independent Markets Commentator.
Have a wonderful set of panelists, and I think the topic can be as contrarian or as controversial as it can be. I think these are experts, veterans in the industry. I think cumulatively, if I look at three of them, the sheer volume of, let's say, transactions they would have seen, bid, won in the IBC is probably a large proportion of the industry. And I think, basis your experience, let's be a little provocative and open in the conversations. IBC, COVID impact, is it too slow a process? Or is there room for improvement as diplomatically as we would always say yes? But what are those? I mean, I think that's the critical one as we move on to IBC 2.0. And more importantly, I think definitely there are some wish lists that you would have seen across sectors, different categories of industries that come under IBC. And very relevantly, two other process, ARCs have been around for quite some time. And why is the sudden need for a bad bank? And would that preclude ARCs and bad banks? There are nuances in the regulations. Does it, let's say, favor one against the other? Some of those, your inputs would be very, very useful. Having said that, ARCs have been around for some time. One of the open criticism is they've not raised sufficient capital. I don't. What's your view on that? Because today I think there is sufficient capital available, global capital, to partner with local ARCs. So if you put all that together, IBC 2.0, how do you see it, and where would you see it? I would request each of the panelists, we will open for your opening remarks for 5 to 6 minutes. Can I request Mr. Bansal to take the lead on this, please?
Yeah. Good evening, everyone. Good evening, Vishal, Shyam, and Mr. Srinath. So let me start with the IBC. I'll come to ARC because presently I'm working in ARC, so I should reply to ARC questions more. But I think the way we started in 2016 with the IBC code, it was a great game changer. Everyone has been saying that. And it has succeeded to a large extent. Initially, up to now, we have been recovering about 44-45%. But the only thing is that you have to understand that out of 44-45, there were 5 steel cases, the large ones, and there was a Birani cement. So if I exclude those 3-4 bigger cases, the recovery figure goes down to about 20-22%. Now, and why is so? Because finally, any process, and especially when you are selling the companies, unlike SurfaceC when you are selling only assets, it requires a strategic interest. So as long as you have good assets, a strategic interest, because here you are not working with the existing promoters or borrowers. So you have to be careful. So you need strategic people, you need good assets, so your recovery will always be good. What we have been seeing for some time, the percentages have been going somewhat low because there are not many buyers in some industries, especially let us say in power, which has been struggling, and especially thermal power because of the environmental issues, not many funds are interested also. The second issue is many of the companies are in EPC space, where again, the resolution cannot happen through IBC. So it has to be with the bank-led resolution, with the help from Vishal or someone. So it can't be, really a sure of only IBC. The third biggest sector is, in fact, real estate. Again, difficult to get resolved through IBC, most of the cases. Some cases have worked well, where actually maybe the completion has happened to a large extent, or only last minute funding is required, etc., depending on the cases. We are seeing that happening in JP Infratech even today, despite plan getting approved 2-3 times, nothing is happening. So I would say it is well up to now. The 1 year suspension has helped. Basically, I don't know whether it has really helped or not, because the IBC process, because of the lack of infrastructure, was suspended even before that. If you really ask me, it was suspended even in February 2020. So, and it will remain like that, because I don't find many good assets. I don't find intention to resolve many cases, and infrastructure is quite poor. So it's moving to some extent like, say, SICA or PIFR or maybe DRT type system, which may be harsh statement, but I'm seeing that happening. Now, if I see the overall cases also, the resolution has happened only about, I think, 300 cases out of 4,000. There are 7,000-8,000 cases pending only for admission. In my own RC, we have cases pending for almost 2 years because of some region here and there. So people have understood the game now. And I have seen people buying assets in liquidation, the same promoters or borrow, with some means here and there. And so, I mean, those type of things have come up in the system. So what next? I would say IBC is not the only solution. You can't expect only IBC system to resolve NPAs of 10 lakh crore. So it should be a combination of all the factors: IBC, restructuring, pre-packs, ARCs, stress funds. ARC and stress fund I'm taking together because in any case, as you rightly said, ARC, though you put it in a different way that ARC is not raise capital, I would say the capital was not available to them. So either you allow me to invest like AIF, 2.5% or 5 crore. You can't expect in cash deal I invest 15% and then 15% nobody gives me money, because banks don't lend to ARCs. So ARCs, I think I will only leave at that thought that perhaps people, we should think today that ARC question should be whether what is required for banks. Instead of that, question should be what is required for investors. In ARC, stress asset fund, it can't be an answer only to the banking industry problem. I'll stop, I think, at that. I've taken perhaps time. We'll come back to question. Thank you.
Shyam, leading on from what Mr. Bansal said, and he's very clearly made an interesting point that it can't be only the banks which actually benefit, it should be everybody else. What's your take? You're seeing it from outside of the country as well as in the domestic markets.
I think Mr. Bansal has hit some very, very important notes here. One on the efficacy of the IBC process so far. And as we know, the start of the IBC is to protect the company. The company is a melting ice. And that's where Vishal hopefully will have more experiences to share. The longer you take, the worse it gets, generally speaking, unless there are hard assets or you are benefiting from some unforeseen cyclical upturns. So the timing is critical, and the timing delays are because of infrastructure, because of call it the process, or call it just other impediments that come in the way. We have been on both sides, as similar to Mr. Bansal. We have actually been having difficulties in putting the companies into IBC from what I see in our ARC. On the other hand, we have actually bought a company from IBC as an investor, which itself was a pretty long process. It was a failed bid from the previous process, and the bidders kind of walked away without any repercussion or penalties to them. And automatically the asset becomes tainted and deteriorating in extremely very quickly. And that creates a very, very difficult environment for both the creditor committee from expectation management and from the buyer on why is he changing the bid from 3 months back or 6 months back to now, because it's not the same company anymore. And this is a very important point that a lot of people miss, that when some bidder, from an investor perspective, I would say, is bidding for a company, there has to be a finite time frame on which he's on hook for. Beyond that, it has to be a different company and a different bid, because the company's fortunes or status change pretty quickly. Second point, I would kind of also talk a little bit on the ARC, as Mr. Bansal has raised. It's very interesting, right? ARC is ARC a principal business or it's an agency business, right? ARC is also a fund manager. They cannot continuously put 15% capital when globally the expected capital from fund manager, who is pretty much depending on his track record or goodwill to raise that capital, right, is like 1 to 5%. So why should an ARC put 15% capital for a cash transaction? And the second part is, unlike AIF, the ARC has a lot other constraints in terms of putting new money in the company, in which whatever companies they are aggregating and curating and hand-holding for recovery. And finally, a permanent capital is not a solution for a temporary problem, right? Equity is a permanent capital. Once it gets inside the country, it's hard to take it out. Or even within the country, if you inject equity, it's hard to unwind that equity and bring it out. And the expectation and hope for everyone is the NPL is not going to be double digit for too long, right? Otherwise, we have just failed in our job overall as professionals as well as fund managers. Therefore, you can't expect massive capitalization in the ARC and for a problem which is pretty much a temporary problem.
So let's go to Vishal. Vishal, I mean, both of you have alluded to one single point that we need to do more for ARCs in terms of the capital issue. Yeah. And two, are we solving only for banks? So taking it from then on, and please do share your views as well.
Yeah.
About bad banks.
So I think so. Mr. Bansal and Shyam have really covered, and made my task easier. So basically, yes, the points are, see, I think so. What I would like to say here is that, see, for a bank and even for the company which is under stress, they all want a quick resolution. And, whether it is achieved either by restructuring or by doing, some equity infusion or by actually doing a sale or, doing finally IBC process. The process has to be, short and sweet. And because, see, a company is running, and every day it loses value. Like Shyam said, yes, what you bid today may not be true for 3 months down the line, because especially in an EPC company or an airline company, we have seen that in the past that, the value has eroded pretty fast. There was a bid at, say, maybe $100 and, the final bid, lenders didn't even recover 10 to 12 cents. So what I'm saying is that there is definitely a criticality in how much time you can actually do the process. The lenders have themselves a challenge that they have to run through a transparent process and they have to have the price discovery mechanism in place. So that's definitely a challenge. And plus, what we've also seen is that, in many of these accounts, there are at least about a dozen and sometimes 40, 50 lenders as well. So, getting everybody on board also is a very big challenge. Even getting the 75% majority is a challenge in many cases. So essentially, IBC started off very well, and like Mr. Bansal also pointed out earlier, that yes, it worked out very well in the steel companies and the large assets. So the large assets which were resolved very fast, and there was a very good recovery for the lenders. But generally, I have seen, in fact, I was just looking at the data, that a large number of companies have actually gone into liquidation under IBC, and essentially the value recovery has been very, very low. So, it's not a panacea, or it's not something which can be applied across the board. Yes, it's a tool which is available. There are a lot of concessions available in the IBC framework, especially under SEBI, which we used to struggle earlier. At least if you go take a company to IBC, you can do that. But also there is a negative side to it. Basically many companies don't want to acquire under IBC, because especially if you're in the contracting business, or if there is some business where there are other customers, there's a potential, cancellation of orders and other issues which can actually impact the value of the company. So last year we did a very good transaction, which was actually a fraud company, a company which was fraud was declared. Yes, yet we was still able to do it outside IBC. because the company had inherent value, and there was we were able to find a bidder who was willing to take all the risks, and the risks which he took were not small. They're pretty large risks, and not many people are willing. So yes, if you can find some such situation, best to go and do a direct deal, or go and deal outside IBC, and do a transparent and a very fast process, so that you are able to conclude the deal before the company loses value. I think so. That's the most critical point, I would say, in the entire process. In terms of pre-packs, I think so. Once the pre-pack framework starts working for the large companies, then yes, maybe it will it may help in the entire cutting down the process time. But I think that is something which is still some time away, because it's only right now for MSMEs what is available right now, and that also will become. We have to see how it actually works. Once it in one or two cases, then we can actually figure out okay, how good the framework is basically on that. Yeah. So I think as far as the ARC, the need for the bad bank, I think that is something which you raised, and I thought let me respond to that as well. See, today the problem is large. There's 10 lakh crores plus different numbers keep on floating around. So, okay, but 10 lakh is a safe number. It's been quoted ample number of places. So even if you take the number of 10 lakh crores as this thing, and so at least 2 to 3 lakh crores of assets among those 10 lakh crores are ones which perhaps no ARC would be willing to touch today, So because even today the current ARCs which are there and the current funds who are there in the market, they also have a capacity, and they also have the they have enough assets to sort of attack and cherry pick. So today there is some need to sort of house these assets in one national ARC or some such structure, where it essentially you can offload these from the current banks. Banks also can then devote their business, their bandwidth to focusing on business, and then some specialized people. And once the debt is totally aggregated, then some people, a specialized team can actually work and basically sort of find a solution for these assets over the next couple of years. So that is the basic idea for a bad bank or a ARC, and it has been done before. Of course, in a very different way. Long time back by IDBI. So it is something, something similar, but not the same. But basically, it's just a mechanism to, sort of unclog the system, as I would put it.
Thanks, Shantae. I mean, the bad bank, if it were to be let's say a level playing field, where, I mean, for example, you expect any bidder in the IBC process on ARC to buy it at market value, not at book value. I mean, it has to be a level playing fees. If that were the case,
it will be there. So no. So it's a two-step process. Let me put it this way: there will be a level playing field. All I'm saying is that, see, today, from the bank's balance sheet, it's going to a specialized entity, and then of course it will be done through a public process. It's not that it will be settled just like that. All I'm saying is that yes, banks' balance sheets are being cleaned up for at least the immediate problem which is there, which is being faced with the banks. That is being addressed.
This is where I want to bring in Shyam again. Any lending institution typically will have an NPA, sometimes extraordinary NPAs, and that's what you clean it up. Do you really see a need for a structure for a bad bank? It's like almost like saying, well, then every other lender want to have their own bad bank, bad book, or can they just carve it out and say, I'm putting it in a repository?
So, to be fair, I think the experiences are out there, and we don't need to reinvent the wheel. During the Asian financial crisis, where at least we were involved, a lot of countries have put up the bad bank. But again, how it can help in Indian context, first is it is aggregation. You are aggregating the risk at one place, and hopefully, and it's extremely important that you're also aggregating the decision making in one place. Because if you don't do that, then it doesn't help anybody, right? Now, second, if you aggregate the risk at the wrong price, automatically the decision making will be again paralyzed. So that's where it's very important that the transfer price is not the book value, it is what the intrinsic value is. And that is the biggest challenge historically, and it's not going to change this time around just because the NPL is 10,000 or 1 lakh crore, 10,000 crore. That's the biggest issue. And there, again, it's a psychological issue that selling at a discount is selling cheap. You can buy something at 10 cents and lose 90 cents of it. And we have had that experience in EPC companies. You can buy at 10 cents and lose 90 cents of it. So just selling at a discount is not a loss. Buying at a discount is no guarantee of gains. And that mindset, once it sinks in, this transfer price could be the biggest inhibiting factor in this bad bank. But if it is done properly, I do agree. Today, 27 banks, 45 people are sitting in a COC, unable to make a decision, which can be streamlined. And thereafter, this bad bank could actually implement various processes and need not be necessarily running as an ARC, can run into IBC, do settlements, do auctions, do SARFACI, provided it is given that autonomy as well as the decision-making power and accountability, but not necessarily continuous supervision, which again will lose the cause, what it has been established for.
That brings me to another point. I mean, you said aggregation and decision making. What about governance? I mean, how do you ensure that arm's length distance and at least optically fair of saying that people who took the decision in the original place are not involved in taking decisions or calls? And when I say people, I mean people, systems, brands don't have necessarily a voice in saying how is this aggregated. Any views on that?
I would like Mr. Bansal also to comment on this, but I would, from my perspective,
about the governance as well.
Yeah, from my perspective, I would say if the same people are running the ARC, or optically may not, but practically yes, that just doesn't work. Once the transfer has happened at a price, whatever has been agreed upon, the ARC should be able to hire and has to hire the best talent available and not go for the cheapest talent available. Again, it's a conscious choice of getting value, not getting cheap. So that mindset, again, is extremely important, because what do we have in a difference between an ARC or a fund versus a bank? Bank also can deal with the NPL, and they do. And some of them do a pretty good job at it, right? But the challenge is the people who are working in a bank in the NPL department are probably the people who are kind of having a side job, right? They don't have the mainstream job, which is lending, right? That is the main job of a bank. So if you are in a sideshow, you're not compensated, you're not promoted, you don't have that stature or status. While in an ARC or an AMC or a fund, this is the main job. And by definition, you have the best people, incentivized, talented, and able to do the job that is required of them. Sorry, Mr. Bansal.
No, Sham, I would just like to add to that. See, in a bank right now, what is happening is that they are devoting a lot of their resources in fighting these NPLs. So effectively, the pool of people is the same in a bank, but a whole lot of people are now currently focused on and the whole lot of management bandwidth is going on sorting out these NPLs, and plus it's spread across 30 banks. So, even if a couple of banks are taking good decisions, they still are dependent on, decision making in another 28 banks or thereabouts. So basically, if you aggregate this, and if you, like you said, you have a setup which is professional and which basically sort of understands the subject and does and the idea is that only that, yes, there will be a setup, mechanics are still being worked out, but, we'll come to know more as things progress. But there will be somebody who will be looking at it and dispassionately taking decisions, and hopefully will not have those problems which we had in the past. In terms of speed of decision making, in terms of the issues at hand, and how best we can maximize the recovery.
That's true. And also the unsaid one before I go to Mr. Bansal is. In the public sector, you have more the stick than the carrot. I mean, a decision going wrong, you're kind of questioned and ostracized. Whereas there is an incentive, both carrot and stick in the private sector to take a call quickly. As Sham mentioned, the melting ice. The sooner you can protect something and take a call and take a haircut and get going, you're allowed. Whereas in public sector, it's a much, much longer process. And And as an individual, most of us would actually tend to say, let's protect, why should I take a call? There's no incentive to take a call. Mr. Bansal, your words, please.
Yeah, so I agree both with Shyam and Vishal to some extent. One point is the idea of bad bank is actually twofold. One, these are the old cases are not getting resolved. But if once I saw the first list of 30, I didn't feel that way. Because some of the cases anyway were getting resolved, still they are appearing in that list. So if it is the idea that the cases which were not getting resolved and you warehouse it, fine. I mean, then it works. But then you transfer at a notional price. But I heard that it will be a price will be determined. Either it could be book value. But if you already 100% provided, then what is the book value? 0. So then the idea was that there will be a notional value of something like 100 crores for each loan. The other thing which is not level playing field is bad bank will give an offer. I mean, national ARC, let's say, and that offer will be put under Swiss challenge so that existing ARCs or funds can match that. But then the problem is that structure is the bad bank will give an offer under 1585 and the existing ARCs are supposed to match in cash. So I thought people who are managing this or who are understanding, they do understand the present value concept of money. You can't compare with 8-year money with the current cash, right? So that means nobody is going to bid at that time. So there the second question comes with Shyam was saying, like say, okay, you are aggregated now and you could not sell at the initial stage because you have put the price and condition in such a way. Unless the initial price itself is very low, then you will be again facing the challenge of investigation. So the third issue is that it goes to ARC. Now ARC, I think in the present system concept what is being planned is not going to be very active. ARC is only a pass-through vehicle here. So it will be done by AMCs actually. So there will be one or more AMCs who will take a call to resolve the cases. So the good point is that you have aggregated the debt, but and I am so told that AMC will have private sector people. In the sense it will not be owned by government. So it will be owned 51% at least by the private sector entities. So hopefully that works that way. I'm not sure because nobody really knows except maybe Vishal what will be the structure. But otherwise, as of now, if ARC is only a pass-through, which is owned by 11 entities which are in public sector, and then it goes to AMC which is able to take decision, I fully appreciate. Then it will be maybe it will be a workable thing. But even today, though Vishal was saying some 30-40 banks, now thankfully number of banks has come down after merger. Less number of banks, but still there are still a few banks who will not agree to anything. And I think Vishal will be knowing more than me because there are banks who have decisions that I don't want to do anything. In that, what do? So hopefully ARC will resolve that problem. National ARC, because once it goes there, at least I have not taken a decision, right? And the worry still remains. And hopefully, I think after transfer to ARC, that issue will not come. Otherwise, even as a banker, I keep on getting notices even today for the case 10-year-old. Even today, about that. I have been working in private sector for the last 4 years. So that challenges remain. So hopefully that will not be there because I agree with you because the incentive is not there. Carrot is not there. Stick is still there. So even after retirement, if you keep on getting all those things, so people are really worried. After all, I have not made anything during that period.
Correct.
So the question is, assuming that, let's say, we put together, we aggregate all this or we don't aggregate, whatever way it goes, the fact is IBC has to take probably a better version of IBC. IBC2 has to come in. But if you look at the last 3 years track record, it has been slow. It has been frustrating. Probably the final winners have got liquid than ice. When they started bidding, it was ice, they got liquid. And turning it around becomes more difficult. The point is, do we have really capacity building mechanisms? I mean, right from the RPs, advisories, the MCLT offices, number of officers or the technical officers that we will need. Of course, there are enough law firms, but do we have enough turnaround specialists? Are we open to getting specialized sectors if you have to bring people from outside the country? So be it. I mean, where are we? Those challenges seem far more daunting than sheer capital or structures? We'll figure out the structure. We'll figure out.
I don't think there is a shortage of people in India. I think most of the world, if you go to any financial center, most of the centers are dominated by Indians only. Okay, whether it is Hong Kong, Singapore, or London. So problem is not that. Problem is maybe the liquidity, capital is an issue, which I think we need to resolve, and we should be ready to pay for it. We can't expect that we should get resolve. I mean, we should get capital to resolve the NPA, and the cost should be only 9-10%. That's not going to happen. That is the problem here. So if I sell assets from banking system and discount it at 9%, then my cash flow, my pricing will never match because I will discount at 20.
Correct.
So the question is that, and banks openly say, like some of the banks openly say, sir, we don't have a policy to lend to ARC. Okay, that's very easy for you to say that. Then I can also say we don't have a policy to buy assets from banks or what. I mean, that's not going to help, no. And he has not helped, at least in this area, not even to clarify to a large extent that you can lend to ARC.
So the last one for Vishal. Vishal, where you said you see far more, I think, macro view of various things happening, policy development happening. So if you were to, let's say, blue sky saying 2025 IBC, what would be some substantial change that you see?
I think we have to speed up the entire process because today there's a 270-day given. So we have to have enough capacity in the court to handle the volume of cases so that, we are able to sort out these cases. And I still feel that, the mid corporates which are there, mid corporates, when I say it's anything less than 1,000 crores, total debt and equity included, anything, those cases are still, there's not adequate investor interest in the smaller companies, I would say, because, it's a promoter-driven company. The promoter only has the maximum, the information and the idea, and it's like a one-man show. So the smaller companies suffer from that. So in the larger companies, and especially in manufacturing sector, there's a lot of interest I've seen. But in EPC and in some other sectors, there is very little interest. And so I think so. First of all, there should be investors who will be interested. Then you should have a process which can be done fast. And then maybe I think so you can, hope to achieve, a quick resolution, so to say. Because once a company goes into trouble, you have to really work fast and hard and find a solution so that they come back out of it as soon as possible.
There'll always be takers at the right price or the right valuation.
Yeah, I know, but what happens is I've seen, moment the recovery goes below 50%, it becomes very, very difficult to get a decision from the bankers, and rightly so. Maybe they have their own concerns, like Mr. Bansal pointed out that yes, it's not a happy thing to receive notices after you've retired. So you may have taken the right decision, but if your choices are questioned, so if the value is above 50, it's still doable. I would say I have seen this. I'm saying from my experience that easier to do deals at that point.
And in fact, I wanted to add here, one more thing is happening. I think this will become a trend after some time also. See, IBC is to some extent one-way street. I mean, you can enter, you can't exit so easily. You will end up either accepting a suboptimal plan or go for liquidation. And the other concern is today in some of the sectors, let's say power, you don't have many players who are ready to invest. And so if you go to IBC, it could be a situation whereby, let's say you have to accept something coming because that's the last option now. Like in Bharat Utpal, DSW, Withdraw and all that. I'm just saying I don't want to name them, but banks are ready to do settlement at 2 crore per megawatt. The same plant which was set up at 5 to 6 crore per megawatt. In recently one case, banks have done settlement because they also know there are not many buyers. So similar thing is happening that so you may end up having only one buyer, suppose, in a particular industry, and that person may give you very low price. So then you have to take a very thoughtful call whether you want to take this company to IBC or not. Better to resolve it outside.
So thank you so much. I mean, I think in the interest of time, we will go back. I think IBC I think we're going to live with it and improve on it. Bad bank or bank, we hope banks stay good banks. I think there's more respectability in the sector. I think IBC, what was seen once as a bad thing to do in terms of that you are seen as a bad businessman if you get into IBC process. I think over time, we will accept that it is not a bad decision to take a company into IBC. There are business cycles which will force you to shut the business. I think if we get into that mode, hopefully we will also start applying some capitalist policies rather than look at them from the socialist lens. And with that, I turn it over back to the host. Thank you so much.
Thank you. Thank you.
Thank you.
Thank you. Thank you, Simon.
Thank you to our panelists. Thank you for giving us such significant experiences and such elaborate insights on what we can expect on the IBC front in 2021. Well, ladies and gentlemen, the Honorable Minister of Road Transport and Highways and MSMEs, Government of India, Shri Nitin Gadkari ji, who was supposed to join us, who in fact has always very willingly been addressing, most of our events and sharing some great insights with us. Unfortunately, today could not join us on this virtual summit because there was some very important and urgent matter that required his attention. Regretfully, we won't be hearing from him today. However, I know, and I think I say this on behalf of all of you, that we were really looking forward to it. However, that session won't be held today. But I must say, what a great and fantastic day it has been. Second day, in fact, at the Mint India Investment Summit 2021. Talking about investment, it's been a great investment of ideas today, don't you think so? From all of our speakers, we had so much of food for thought and, more importantly, action. So as we conclude the second day, here's another shout out to our fantastic partners, without whom the event couldn't have been a raging success. Thank you to our presenting partner, Trilegal, co-powered by MIDC, Maharashtra Industrial Development Corporation, associate sponsor CoinDCX. Tomorrow will be one such thought-provoking day, as we've reserved some of the most powerful conversations that will headline the summit. Now head over to your social media and tell us, what were your key takeaways from today? What were your thoughts? Any questions, any learnings of today? And don't forget to use hashtag MintIIS. I'm Xenia Fernandez. It's been absolutely a pleasure hosting this day, and we'll catch you once again tomorrow at 2 p.m. sharp at your screens. Thank you and have a great evening.